part of the problem is that people are still getting hired, earning real wages, and spending. And you see that consistently across all earnings. You see that consistently. We're going to get Airbnb earnings today. We're going to get some others. The same kind of trend seems to be prevalent everywhere. So then how do you get confidence that really you can kill the inflation beast lowering rates when it doesn't seem to be all that restrictive? We haven't seen that sort of credit tightening that you would expect given how much they've raised rates.
Jennifer, can we talk about the consumer as well? It's not just CPI this week, it's retail sales in a couple of days' time. We've been talking about a consumer running on fumes now for 18 months, and it's still going. Jennifer, how strong is that consumer now?
Obviously, the consumer is still in pretty decent shape, and I think it all goes back to the job market. Even though the job market has cooled, we're not seeing job gains of over the 500,000 variety. Of course, 300,000 is still pretty strong, but as long as there is still decent demand for jobs or for workers, everyone is making a decent wage, that I think is enough to keep the consumer going. They don't have to spend it all. They can put some aside for a rainy day, as we say all the time, and that's okay. It doesn't mean that, again, whatever you're making, you don't have to blow it all right away. As long as you save some, it's a good thing, and that keeps the whole fundamental support below the U.S. economy going. And as long as, again, wages continue to rise, job demand is still decent, I think that will keep the consumer moving forward, at least.
I'm struck by the polarization of people who we speak to in the new paradigm. Is it going to be a reinflationary kind of paradigm, or is it going to be one where we are deceived by the strength in the economy and there is a downturn that surprises everybody? Earlier this morning, we got small business optimism data out of the NFIB, and actually fell the most since the end of 2022. And here we are talking about the resurgent demand, this incredible strength, how everyone is bullish. What is the risk from your vantage point that we're worried about the wrong thing and that really it is the deceleration that's more present?
I'm actually quite worried. I mean, whenever I see numbers continuing to beat expectations, especially, just like look at the last couple of GDP reports where we saw the initial number in Q3 was like over 5%, 3.3% in Q4. And, of course, I'm always thinking, what are we missing? What is the market missing? But, it all goes back down to the labor market, but at some point, over 500 basis points of rate hikes, that is starting to have an impact. And it's just not having as much of an impact as one would have imagined during during normal times. And these are definitely not normal times. And this is why we are sticking for the Bank of Montreal, we are sticking to for our Fed rate cut calls, just not until the second half of the year. I don't believe we're ever in that March camp, and I think June, July is probably the most likely scenario for the rate cuts to start happening.
You're not alone. It seems like a lot of economists on Wall Street coalescing around the same month now. Jen, it's good to hear from you. Let's do this again soon. Jennifer Lee there of BMO on a CPI data that comes out in about 1 hour and 36 minutes time. That CPI data, if you are just joining us, 2.9% is what we're looking for here. Headline, year over year, down from 3.4. Stripping out food and energy, headline for core, 3.7, down from 3.9. Many of you on Wall Street want the month-over-month figure. 0.2% is the estimate in our survey. Stripping out food and energy, 0.3% is the estimate we're looking for month-over-month. If you talk about the labour market and price pressure, Andrew Hollenhorst has got something to say. We continue to see a stronger underlying trend of inflation, Lisa, due to factors such as wage inflation continuing to move sideways at around 4 to 5%. This is what Jen's talking about.
That basically, ultimately, it comes down to the labor market. And guess what? The labor market is surprised to the upside, whether it's surprising to the upside on the jobs numbers, whether it's surprising to the upside on wage growth, or whether it's surprising, a good side, kind of surprise to the downside in jobless claims. Here's really sort of the dissonance that I find. Yesterday, everyone's kind of talking about reinflation risk, and then the New York Fed puts out 3-year inflation expectations from consumers. It falls to the lowest since at least 2013. Everyone piles into bonds. Yes, game on. The Russell 2000 rallies. Everyone is waiting to coalesce around that story.
Chris Ferrone, strategist.
Exactly. Completely bullish Chinese equities.
The equity market broaden out. Take a look at China.
Exactly.
When you hear that, yeah, sentiment is pretty high.
So I just wonder, is that sort of the bias right now? People are looking for that confirmation of the disinflation.
This conversation is going to continue in the next hour. Stacked lineup. Jim Jim Zauter of Apollo Asset Management, David Balin of Citi Global Wealth, and Leslie Vidjamuri of Chatham House. That is coming up in the second hour of Bloomberg Surveillance. Going into that CPI print, here are the scores for you. Equity futures negative 0.4% on the S&P 500. In the bond market, yields at 416.37. I went back to have a little look at where we were the last time we got a CPI print. At the close on January 11th, the 2-year that day closed at 424. The 10-year closed that day at sub 4% at 396. So yields have shifted higher, and yet this equity market is positive over the same period.
It's positive for the right reason. That's what people say, that yields have been higher just simply because the growth is just so good. And
data was good. Earnings was good.
We can keep going.
You sound fed up with this conversation already.
It's just, it's not that I'm fed up. It's just that we're not going to get an answer.
How do you plan to get through 2024? When it's the middle of February, you're already sick of politics. Sick of politics.
Well, give my kids something to do today, and we could have a better, more constructive conversation.
From New York City this morning, good morning. The second hour of Bloomberg Surveillance up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
It does seem like if it's just steady as she goes, then the Fed wants to be cutting rates this year.
As long as we see this gradual progress down, they should be in a position where they feel confident of wanting to cut.
You're probably going to see a cutting cycle start in May. By May, they should have enough evidence, specifically on inflation.
We're also beginning to see more broadly an economy that generally is doing quite well because of the easing of financial conditions.
You've got better economic data. We've still got the prospect of rate cuts coming up, but inflation is coming down. That's a perfect pro-risk scenario.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
CPI data 90 minutes away, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market's negative here by 0.4% on the S&P. There's a new bar for some Fed officials, Bramo. Not a bar where you drink, just a threshold to start reducing interest rates. Well, TK, if you're listening, don't get too excited. What they want to see is not just more data, they want to see a broadening out in the disinflation story.
I was trying to think of the Jackson Hole bar that, you know, he likes to talk about, but there is this idea that if you start to see other factors other than food and energy really play into why we're seeing such disinflation in goods in particular, then they'll feel more comfortable. It's a new threshold, whether it's just them trying to say something to sort of placate all of the questions, what's your new threshold to actually cut rates? It hasn't moved the needle in terms of market expectations. What will move the needle, though, is if we get this data and we do see shelter and we do see other costs contributing much more to the disinflation.
The data so far this year has given them pause for good reason. We've talked about that really strong payroll story, wage growth beneath the surface. On top of that, the ISM came out, 2 Mondays ago? Prices paid started to click higher as well. There's reasons to just sort of sit back and say, let's wait.
The disinflation has been driven by objects, products, things that people buy. It has not been driven by people going to bars and buying drinks and going to restaurants where you can see the prices are significantly higher because people are getting significantly higher wages. Until you start to see that coming in materially, people aren't going to feel comfortable. The bottom line is this: can inflation come in simply because this was transitory? Or is this something that is a new paradigm where people are getting paid more and spending more and there's a greater inflationary thrust?
Plenty of earnings out there as well. Just getting numbers from Coca-Cola. We'll go through those numbers in just a second. I just want to turn to the latest down in Washington, D.C. as well. Whenever we talk about price pressure, you need to talk about fiscal policy down in Washington. I know this may not go anywhere, but it's another $95 billion bill down in this Senate in Washington.
$95 billion deal for foreign aid. This would be going to Ukraine, to Israel, to Taiwan, to these national security concerns that the U.S. has foreign, globally. But of course, before the senators even took that vote early this morning, there was a filibuster all night. You heard from Speaker Johnson, who threw absolute cold water on this idea and basically saying the House is going to go its own way and the Senate is not doing the will of the American people. What you see now, and partially what we just discussed with Ambassador Haley yesterday, Jonathan, is this divergence and almost war within the Republican Party. You have these absolute defense hawks who want to send these military weapons to Ukraine, and others who say we should be backing out of foreign aid and have a more isolationist approach.
That increasing isolationist approach showing up in poll after poll over the last year or so. Let's go back to Coke. If we can bring up that stock in the pre-market, not doing much at all, Lisa, just going through the outlook, a little bit better than anticipated.
Yeah, people are still buying Coke, and Ozempic doesn't seem to be cratering their earnings. Adjusted organic revenue is expected to be up 6 to 7%. The estimate was 5.9%, so a little better than that. They do see a 2 to 3% currency headwind for the year. We do hear this occasionally as something that people refer to, given the fact that the dollar is strong, what that does to overseas. When you take a look at the mix, though, nutrition, juice, dairy, and plant-based beverages were up 6%. Water, sports, coffee, and tea unit case volume was 0%, but soft drinks went up 2%. So if this is like the Ozempic mix, it still is, you know.
Are you alluding to the conversation with James Quincy in Davos last month?
You don't say. Yeah, I am.
Is this the pivot that he was basically suggesting?
Well, I'm wondering if that's kind of what's going on. I mean, you are seeing
more. They already
more
make the goods that
nutrition.
people want.
People want nutrition if they're going to be, you know, caring about their health more, and you are seeing that increase more than the soft drinks.
And protein drinks and stuff like that. Stock is barely moving, positive by 0.2% on Coca-Cola. The broader equity market story on the S&P shaping up as follows. Equity futures on the S&P look a little something like this. We're just a touch softer. We're negative here on the S&P 500 by 0.5%. In the bond market, yields are lower by single basis basis point, 416.57 on a 10-year. Stacked hour for you. Coming up on the program, Jim Zauter of Apollo Asset Management on the firm's record-breaking year, David Balin of Citi, ahead of today's crucial CPI report, and Leslie Vinjer-Murray of Chatham House on the $95 billion aid package passed by the Senate in the last couple of hours. We begin with our top story. US stocks are very close to all-time highs as earnings and positive data continue to support sentiment. Apollo Global Management posting a record in 2023 for private credit, the firm reporting more profit last year than the previous decade. Jim Zauter of Apollo joins us now for more. Jim, it's good to see you. You're with us for the hour. Good morning to you.
Good to see you too. Always welcome. I appreciate the invite.
Well, thank you for coming on. Let's talk about these earnings. Well received by this market. What's underpinning these trends for you?
Well, I think it's a repeat of the secular trends we've been talking about over the last several years. You know, certainly we have a business and an industry that gets better every day as there are more and more retirees and savers looking to think about retirement income on our annuity business. At the same time, you've got an evolving banking system, which I'm sure we're talking about, where lots of companies are looking for a variety of capital solutions. We have the broadest toolbox. But as an industry, it's a secular change, and we've been fortunate to be right in the middle of it. But you're right. We had a business last year that hit on all cylinders. All parts of our business were able to, first and foremost, great investor performance. Assets and asset gathering follows performance, and we did so on a very strong risk-adjusted basis.
You went there early, so we'll go there early. What this means for the banks, there is a sentiment out there. You know how this is portrayed in the media. Sure. It goes something like this. Apollo's killing it, the banks are struggling. It's that their loss is your win, your gain. Yeah. Is that how it works for you?
Well, the reality is this is a brutally competitive business, and it has been for the 39 years I've been in the business. Whether you're in the banking side, or the asset management side, or anywhere in between, you know, the competition for market share for assets is always brutally competitive. But certainly it's a great narrative right now. The reality is there's much more of a symbiotic relationship that exists, and we're a major counterparty of all the large U.S. institutions, and even globally in Japan and Europe as well. So it's not certainly on any one transaction, a buyout financing, whether it's going to go to the broadly syndicated market or it's going to go to private credit. These are all they're competitive within our industry, and they're competitive within the banks. That's never going to change. But the reality is the financing that takes place, the counterparty financing that we get from the large institutions, really critical to our business. We provide them a lot of financing fees and opportunities across our equity and debt businesses. So there's a narrative that sells papers, and then there's the reality, and it's somewhere in between.
This is like in high school when they're two friends and they're kind of always talking about each other behind their backs, but they're really polite to each other because they kind of operate in the same circles. I'm just saying, Morgan Stanley frenemies, a little bit. I mean, the idea is Morgan Stanley bolstering its private credit portfolio to $50 billion in the medium term. Goldman Sachs reportedly aiming to double the size of its $110 billion credit business. They want to fight back. Don't you kind of feel that?
Yeah, again, we're in a really competitive industry with the smartest, most determined minds in the globe, in the U.S. and Europe. The reality is, in the end of the day, it gets about your business model, how you fund your business, and the client product that you're bringing to solutions. So there's no doubt. I mean, there's no doubt that there's going to be firms that are going to start private credit businesses. But again, let's take a step back. As I've talked to you many times in New York and in London, private credit is broader than just the sponsor buyout business. It's a great headline product. It's a great headline tool. But the reality is that's a $1.5 trillion market. The reality is private capital, private credit is a $40 trillion opportunity. And that's where, when we see what we're doing in terms of aircraft finance and solar finance and a variety of trade and inventory finance, that's where we have a really competitive toolbox because of the structure of our liabilities, the duration of those liabilities, and the cost of capital. What we've really done at Apollo the last 10, 12 years has really brought our cost of capital down dramatically. If you're just in the PE business, your cost of capital is mid to high 20%. If you're in the mezz or distressed business, it's in the teens. When you have an annuity business, and the reality is in this higher rate environment, more people like to buy annuities. Annuities had a record volume last year. That just brings in a lot of long duration, lower cost capital. So our ability to be very relevant to any client or borrower it's really a defining characteristic.
How much has the money that you're talking about, which is coming from different sources than traditionally, basically been the reason why we haven't seen the credit cycle that so many people were expecting?
Well, I think it's a very interesting question. I think what's going on right now, and I know you had Torsten here yesterday, is, last year you had the equity markets up 20-something%, broadly speaking, and at the end of the year you had defaults approaching almost 5%. That's a pretty unique characteristic. Usually when you see defaults rising like that, you have a declining economy. The strength of this economy has befuddled economists and all your guests for the decade, and if you look at where all the dot plots have been, even those folks who have all the information have missed this. Now, I think once we all say that there's not going to be a cycle, I do think you are seeing some signs of a hardening of economic conditions that are finally coming up. We'll see it in the next few weeks. I think the Fed's made the right choice. I think I talked several months ago here about the Fed put us back. They put themselves in a really interesting position right now where they can mute volatility with having a lot of bullets left in that gun. But I do think there's a modern economy that's going on right now. The depth and breadth has surprised economists and guests across the board. And it's a much more resilient economy. The U.S. economy is the bulwark of the Western world right now. It really is.
Economy's strong, and I think you told us before Christmas, basically the Federal Reserve has the space now because of lower inflation to respond to negative shocks. What I'm trying to work out, though, of the issuance that we've seen so far, and this is more in public markets where Lisa and I have been talking about this boom in supply to start this year and this flood of demand. Is that because the economy's strong, or are we just anticipating lower rates this year? Which one is it?
I think it's a combination of, the U.S. consumer has prepared themselves very well for a higher rate environment. Corporate balance sheets have prepared themselves very well for a balance sheet. And when people see financing opportunities, they know now that, don't wait around for perfection. And I think that's been a good lesson. Don't let perfect get in the enemy of progress. And I think there's been a very, very thoughtful, there's no doubt there is, when people see what's going on where rates were supposed to be going, there has been a rush, and there is a risk-on trade right now in virtually every asset class. The market has priced to perfection in virtually every asset class, and that means it's a good time to issue. I'll tell you, for us, we typically underperform in periods like this. We have a lot of cash on the balance sheet at Athene right now. We're very low levered. We've put ourselves in a position, if there are pockets of volatility, we're going to be well positioned. But that's how we prudently, when we have a macro view, that's how we express it.
It's a classic approach. You want to be the liquidity provider in times of stress. It makes perfect sense.
And I think the story that really has not been spent a lot more time on, this issue of market structure, the rise of passive, the lack of companies' ability to really do, the equity market is, and the equity IPO market is fundamentally challenged. And I know SPACs were not the answer, but in our view, that this market structure issue has been going on for several years. It's going on for a decade. And the advent of passive in scale, now more than 50%, I think that's going to have profound implications on how companies raise capital going forward.
We've got time to work through that, through the ad, because luckily you're going to stay with us. You mentioned credit stress. In fact, that's my word. I can't remember the word you used precisely, but I do want to ask you about that. Are you seeing pockets of stress right now? NYCB, commercial real estate, we talked about it for the best part of 5 minutes, market moves on. What are you seeing?
I think you are seeing, in a very broad growing economy with massive fundamental strength, you're seeing some situations where companies either poor business plan or way too much debt and have not maybe recovered from the COVID crisis. You're seeing that a little bit more in the corporate world. In the U.S. consumer, the average mortgage is 3.8%. We've not seen the pain that's been seen in the U.K. and Germany. That's really protective. So you're seeing some signs of challenge and weakness, but there's been a tremendous amount of private equity activity and financing activity the last 5 to 7 years. So the fact that you're going to have some stray challenges around the edges, interesting. I don't think it's a macro telltale sign of things changing, but there are challenges out there, no doubt.
Jim, it's great to have you with us. Jim Zelter of Apollo Asset Management with us for the next 45 minutes or so. Your equity market on the S&P pulling back by, let's call it 0.4% on S&P 500 futures. Here's an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. New York City residents are being urged to stay home today. The city's forecast to receive up to 8 inches of snow. Mayor Eric Adams closed public schools and moved students to remote learning. 7.3 inches of snow in Central Park would be the most since January of 2022. Areas north and west of the city could get as much as a foot. Areas of New Jersey, Pennsylvania, and New England could see as much as 12 inches today. Shares in JetBlue are higher in the pre-market trade. Activist investor Carl Icahn disclosed a 9.91% stake. Icahn is now JetBlue's third largest shareholder behind BlackRock and Vanguard. The stock fell 30% in the last year. Federal court struck down an alliance with American Airlines and a planned takeover of Spirit Airlines on antitrust concerns. Icahn said that he's had talks with management about a board seat. And shares of Manchester United are climbing today. Billionaire Jim Ratcliffe said he'd extend his offer to buy a 25% stake in the club, pushing the deadline to Friday. In December, Ratcliffe said he would purchase the stake by allowing investors to swap 1/4 of their Class A holdings for $33 per share. That's well above the market price. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on the program, investors looking ahead to CPI.
I think the inflation news is going to be okay for now. I think the growth news is going to continue to be good. So, look, no one's really worried the Fed are going to start hiking again. We're going to keep that prospect of rate cuts out there.
Live from New York City, that's next on the program. The data, 1 hour and 15 minutes away.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Inflation data just around the corner. Here are the scores going into it on the S&P 500. Equity futures a little lower. We're negative 0.4% on the S&P. Bond yields lower by 2 basis points. 4.1599 on a 10-year. The euro not doing much. 107.78. Under surveillance this morning. Investors looking ahead to CPI.
I think the inflation news is going to be okay for now. I think the growth news is going to continue to be good. So, look, no one's really worried the Fed are going to start hiking again. We're going to keep that prospect of rate cuts out there. I think we do get to 4.5% on 10 years. So I would be short duration here. That fits with the story of better economic growth, pushing out the rate cuts. And if inflation does come back more meaningfully, I think you're going to see that curve steepen up. So
here's the latest this morning. CPI data due out in just over an hour from now. The median estimate in our survey calling for the headline number to drop below 3% for the first time in nearly 3 years. David Bailyn of Citi writing this, signs of economic growth and recovery are spreading faster than most economists believe possible. Perhaps all the rate increases and restrictive monetary policy of the past 18 months won't slow the economy in 2024 very much. David joins us now for more. David, I wrote it down. Need to be careful how I read this just to get it right. Is the slow then grow becoming the grow and grow? Your words. Is that what's happening, David?
Yeah, that's sort of the big surprise, Jonathan. We actually are seeing no slowdown. We expected the economy to slow at the beginning of 24, and it's not. A lot of reasons for that. I think the consumer has stayed, healthy. Like you said, inflation is coming down. We actually see real increases in wages taking place starting in November all the way through now. Very healthy consumer balance sheets, right? And really the end of inflation. The big story that's happening for the consumer has to be that import prices now are negative. We're importing at 3 to 4% less cost from China than we did before, and that is rolling through our economy. So when you take a look at the consumer continuing to buy, what we see is an increased amount of consumer confidence, and you can see that in the Michigan index over the course of 2 out of the last 3 months. That index is up considerably. All of this, right, is going against the fact that the Fed has kept rates higher for longer than we would have expected. And that, is really the quick story of the beginning of the year. Things are going better than we thought.
Consensus was bullish coming into the year and bullish on the idea we got early rate cuts. We've pushed out those rate cuts off the back of the data that you just described, and yet we are still bullish. Have you changed your market call off the back of this data?
No, actually, I think our market call is more bullish in terms of both earnings, right, and potentially what the S&P, could do for the year. We've seen a pretty big pickup in the market across a broadening sectors. We've seen, small and medium-sized industrial companies, up 21% for the year, things like that. So I think what we're seeing is that the market is telling us about what the economy is likely to do over the course of the next 6 months. And that will then turn up, Jonathan, in our earnings, right? We thought earnings would be up 5% this year, and it could be that they're up 6 or 7%, which is, again, considerably more than we would have expected. All of this supports the market activity, but it does support higher rates for a longer period of time.
I wrote this down just so I could get it right. Is bull then bear becoming bull then bull? I mean, is that essentially what we're talking about? Because people were expecting some sort of deceleration later in the year. At what point, since I like to worry about things, does bull then bull lead to a resurgence in inflation?
Yeah, Lisa, that's the thing that I think people are worried about that is least likely to occur. Citi Wealth's biggest call is on the fact that inflation is going to stay moderated. And there are lots of reasons for that. Input costs, finished costs coming in from abroad, the fact that we don't have, materially increasing labor costs in the United States, and the fact ultimately that the economy has normalized after COVID, so the supply chains are working. All of that suggests there's no reason to believe that inflation is going to be our bigger problem.
Given that, there is a sort of question around your colleague, Jason Williams, writing this when he was saying the market should price in some risk of future hikes. Look to 1998. This cycle could be more akin to the 1998 easing cycle, which was short-lived and led to more rate hikes. Are you baking that into your expectations, or is it sort of to each his own, because this is basically pick your own adventure, depending on who we talk to? I mean, honestly, it's a very confusing moment.
It is a bit confusing, but I think that the Fed is signaling to us that they're going to be very prudent about not lowering rates quickly, but there's no indication that there would be any reason to raise rates. And so what we could have is a very shallow, upwardly sloping yield curve, that rates don't go down as much as we thought they would 6 months ago. Again, we thought that it was a 350 to 375 10-year at the end of this year. That may not happen. The bigger story is going to be equities. And the fact that, last year, fewer than half of the equity sectors were, had positive earnings. This year, we think it'll be 90% or more, 2025, all of them. And I think that the equity story and the ability for equities to go considerably higher as earnings, become clear is what we have to focus on. And there are fewer and fewer value parts of our market, with the exception of areas like healthcare. There are indications that that markets are anticipating everything we just talked about.
Hey, David, great to get your views, sir, an update on them. David Baden there of Citi, with us around the table, Jim Zalta of Apollo. Jim, can we talk about public markets for a moment? Nvidia and Microsoft, I think, are as big as the Euro Stoxx 50 now. Is the big just going to get bigger? You talked about the evolution of passive flows over the last decade or so. Have we tested the limits of that yet, just in terms of the big continuing to get bigger?
I don't think we've tested the limits, but there's no, the impact of the Magnificent Seven, and if you look at the valuations, other than Alphabet, they are dramatically higher than the broad indexes. And the manner in which capital formation happened for hundreds of companies is certainly changed. But yes, the Magnificent Seven have had a spectacular impact on performance. And if you're not, as a equity manager, which we are not, if you're not participating from that group of stocks, you will indeed underperform, which most folks have done.
Is there an analog in the credit world, though, where basically big companies do better have better performing credits, and that's sort of a sweet spot for you, that you go after big companies with bespoke solutions, that you go after because you're confident they're going to survive in a different way than smaller businesses that don't have the same sort of strength.
Certainly that is the key to our view of the markets today. The traditional, I've been in high yield since the mid-'80s, a little aged, but the single B, $300 or $400 million single issuer of high yield bonds, no one really wants to buy that today. That is a dinosaur of the past. Those companies are certainly using the private credit where they can club a transaction. But for our business at Apollo and several of our peers, we're focusing a big portion of our origination on investment grade quality risk. We have the scale and capability to do so, but yes, there's no, when you are concerned about an economic cycle that people have been concerned about since really 2016, 17, where's the credit cycle going to end? You constantly wanted to go higher and higher in credit quality, larger companies, less commodity or one risk companies. The best thing, one of the best things happened on our platform is we went through 2016 and we learned a lot of lessons from investing in and around the energy complex with debt, which we will not do again. And very, very different scenarios today.
We're going to tease more of that out in just a moment. Jim's out to sticking with us. Coming up, the AI rally continues. Meta and Nvidia leading gains in the S&P 500 so far this year. That conversation's up next. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration. They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Live from New York, 60 minutes away from that inflation data. Equities look like this on the S&P 500, pulling back. Session lows, but only down about 0.5% on the S&P. On the Nasdaq, down by 0.75%. That's picking up. The small caps, the Russell, negative by 0.4. In the bond market, 2-year, 10-year, 30-year yields higher over the last month or so off the back of stronger than expected economic data. Yields this morning on the session lower by a couple of basis points, 416.18 on the 2-year, 446.77, really close to 450 here, Lisa, off the back of stronger payrolls, stronger ISM, services and manufacturing. Jobless claims last week, a little bit lower than anticipated.
Basically, pick your data point, and other than the small business optimism this morning, everything's been performing better than expected. We see the Citigroup Surprise Index, Economic Surprise Index, surging to the highest levels going back to November. Again, the key question is, when does this create an inflationary problem? And we heard from David Balin, you know, bull then bull, because essentially it's not going to be as much of a problem, and that seems to be what's getting baked into the market.
And now he's even more bullish, apparently.
I guess that's the theme of the morning.
Yes.
It's that bulls are getting buller.
Basically. Is that how you're framing it? Bulls are getting buller.
I mean, that's essentially where we're at right now.
I'm just looking for the headline in the newsletter
Well,
a little bit later.
I'm working on it. I'm kind of playing around here.
Good. Okay, keep playing with that.
Thanks.
In the FX market, conversation about who cuts first, ECB versus the Federal Reserve. Based on the data so far in the US, that Fed call's been pushed out. The euro, slightly positive by 0.1%, 107.82 on the euro against the dollar. Under surveillance this morning, US CPI data 60 minutes away. Bloomberg survey forecasting an annual read of 2.9%. This would be the first read below 3% since March 2021. Core CPI expected to jump year over year, but would still mark the smallest advance since the spring of 21. Bloomberg Economics also expecting the report to show less disinflation in core goods, but more in services. And Lisa, that's the handoff we're looking for.
The broadening out as we try to get to some sort of confidence that this can continue. This is going to be a very analyzed report. You're going to get the headline figures, and then the real analytics is going to be what people are looking for. How much is being driven by services? How much is being driven by food? How much is being driven by rents? How about those healthcare bills? How about the car insurance? That's been surging. So at what point does that come down, and suddenly people start to get a little bit more confident?
And then it gets very personal very quickly, and people start to say, that's not where inflation is. I'll tell you where inflation is. The Fed's going to tell you what it thinks about it. Goolsby speaking a little bit later this morning, then on to Mr. Barr, and then you're going to hear tomorrow, rather, Goolsby and Barr, then on to the following day, Waller, Bostic, then Barr and Daly. Plenty of Fed officials this week, Lisa, to respond to this.
And maybe they can also talk about the broadening out kind of thresholds. The key question is, we've heard from a lot of Fed officials, what have we learned?
Very little.
Yeah, I mean, I don't really have a sense of any more clarity.
One thing stands out. There was a takeaway from the last news conference that maybe Chairman Powell was struggling to herd cats. You were talking about it. I've heard very little difference in between the Fed speakers that we've heard so far over the last couple of weeks. They all seem like they're on the same page to me.
It's a great point. The one differential is, what is that threshold that would allow them to cut rates? Maybe that's where maybe some of the daylight is coming. And so maybe these sort of broad concepts like confidence and broadening out become subjective and become momentary, you know, pauses in their consensus. But this is a good point. This
As
is
we
not
like to say, maybe a difference in degree and not kind.
Correct.
We're having a conversation about maybe a separation of a couple of months. Maybe some people want to go in June, maybe some people later. I'm not sure how much value is in that.
There's still cats. They still want to go.
Let's herd cats down in Washington. Do you want to do that? We can herd cats down in D.C. and the Senate and the House as well. President Biden pushing for a 6-week pause in fighting between Israel and Hamas. The president making the comments alongside the King of Jordan during his visit to the White House. Israel Prime Minister Benjamin Netanyahu vowing to continue a military campaign in the south of Gaza, where about 1 million people have fled during the course of the war. Earlier on this morning, the Senate passing a big bill. What is it, $95 billion of aid?
That's right, $95 billion of aid for the U.S. national security concerns around the world, Taiwan, Ukraine, and Israel. Now, while it does feel like they're moving in the right direction in terms of what the president's priorities are, we know that this is at the moment dead on arrival in the House of Representatives. Speaker Mike Johnson came out before they voted basically saying, you do that in the Senate, we're going to go our own way. But it's an important day for the president when you talk about the hostage negotiation, because you do have his top diplomat, Bill Burns, the director of the CIA, in Egypt with the head of Mossad. So potentially if there's going to be any movement on a hostage negotiation, we could see that incremental move today.
On a lighter note, here's an update for you on the Super Bowl figures, setting a new record for television viewership. CBS saying 123 million people tuned in to watch the Kansas City Chiefs defeat the San Francisco 49ers. That's a 7% increase from the previous high, which was set last year. The numbers include both the CBS network and the parent company's streaming service device, Paramount Plus also delivering the most streamed Super Bowl ever. Just amazing, Ramo. Altogether, 123 million.
So I did some field research last night at the dinner table, and I have to say there were a lot of hate watchers. You know, there are people who watch because of Taylor Swift, then they're the hate watchers because they kind of hate that she's the main thing and they think that she's wrecked football, but then they're watching because of her. And it was just, you know, there were a lot of passions.
Taylor Bowl.
Yeah, well, I mean, I don't want to go there because I'm going to get hate mail because the haters want to hate.
And they don't want to talk about it either way, but we can talk about how dominant NFL has been on viewing figures over the last 12 months. Just absolutely dominant. There is no other game in town.
Which is the reason why everybody wants to buy these rights, and which is the reason why how can you sort of create a bundle or something like that that can get said rights in some sort of consolidated place, because that will be the secret.
Just think if there was an event in America before a massive presidential election where you can talk to 123 million viewers.
And then you skip it.
And you decide to skip it.
I still can't make sense of it. Why did he skip it?
Well, I think, you know, I spoke to some people in the campaign who say it's still so early on in the season. I also think the fact of the matter is there's a lot of questions right now about the president's mental acuity, especially coming after that report. And potentially they thought that this would be the wrong message he wants to send. He clearly wants to send a message about the economy. He was out again speaking yesterday about the economy, labor market doing well, inflation coming down, the little bit left inflation that you're struggling with at home. It's corporate greed, it's shrinkflation. But yeah, they skipped it, and a lot of critics are saying this was a massive missed opportunity, especially when you look at these record numbers at the Super Bowl.
Jim, if you could get a baseball cap and write Apollo at the front of it and put it on top of Travis Kelce, you would, wouldn't you?
We did it with Patrick Cantlay.
It's working out, that is.
Working out well.
I messaged you the other week. I saw Cantlay on TV on a golf. How does that work? How much response do you get to something like that?
Well, I think it's a first foray for us in thinking about connecting our brand with a broader audience. And, you know, for us, we've got a 33-year, 34-year track record, but most people still think of us in what we used to be as a PE firm. We're now a much, much broader platform. So a lot of it is just client brand.
Lisa's laughing because she noticed how I got from football to golf.
I mean, basically,
quickly.
Super Bowl to let's talk about golf.
Let's talk
that's
about
more
golf.
interesting.
I think
I'm a Buffalo Bills fan, so it was a hard game for me to watch. It's been a tough.
Jim, you're talking about how this brand's going to change. Can we just talk about how 401ks might change as well? Rowan on the call in the last week or so, you know where this is going. You talked about old sin 401ks. How is this all going to change in the weeks to come, months to come, years to come?
Well, Mark pointed out the great irony of the whole idea of DC and savings for 20, 30, 40 years, and yet because of the systematic structure, really mandating daily liquidity product. And the idea that, you know, liquid is safe and illiquid is risky, I think that paradigm really needs to be questioned. When you look at where returns are over the last decade or so, we're talking about market structure, we're talking about the advent of passive, and when you look at actual underlying performance of a variety of so-called illiquid alternatives, they've performed in a robust manner across a lot of cycles. And that's taking notice from investors who are long-term. You know, the so-called endowment model for the last 30 years has taken advantage of the liquidity structure which they do not have to live by. And so if you have a broad DC market that has long-term objectives of retirement income and retirement safety, why are we exposing them to the most liquid, volatile aspects of an asset class? Well, it doesn't really make a lot of sense.
There is a concern that if you have people who have the ability to withdraw on a daily basis and they're investing in longer-term investments, that it creates a potential for a run on those assets, that if there is some trigger and people do decide to withdraw their cash, it creates forced selling that can create a spiral.
Well, they already do actually. If you're in a DC plan, you're in daily liquidity mutual funds, which you can redeem any day right now. So that institutional structural liquidity drain is already in the markets. I think that we've been very careful, as many of our peers in the alt set, not to offer daily liquidity products because we never want to get into that asset liability mismatch. The whole reason why annuities have done well the last several years, but exceptionally well in the last year, is because that there's the longer duration of those vehicles to be able to reinvest and have the long duration versus a savings account that we saw what happened with SVB or other bank challenges.
Are you worried that in an environment where everybody wants exposure to private assets, that there are bad actors that are offering things like daily liquidity, underlying investments that are much longer term, that could create forced selling, that could create something that you don't want to be next to?
You always have to understand what the weakest competitor may do, but when you go back over the last, in my career, you know, the one that really sticks out to me is the idea of the UK pensions in, 4 or 5 years ago with the LDI crisis. Those are the ultimate long duration investors that because of moves and gilts had to sell all their CLO liabilities. So we have great concern over this corner, but the reality has happened in a very, very different neighborhood. And so, yes, you have to always be, I do think it's interesting that all the public and all the leading alts folks have not gone into the daily liquidity product. And that will be a question on what types of vehicles, if you were either a provider of those or a parts provider for larger firms, how you go down that path. But certainly we're very, very focused with the discipline of making sure that we can never get pulled away from the table on an investment mandate. That's one of our critical philosophies of how we invest.
I just want my 401k right now to be max long, one name, ARM. ARM has basically doubled in 3 days. Can we bring up the chart quickly and have a look at this? A 3-day rally driving the stock up by almost 100%. The winners of the year, basically the winners of the last year, Nvidia and Meta on the S&P 500. Nvidia briefly overtaking the market value of Amazon during yesterday's trading. Mandeep Singh of Bloomberg Intelligence is with us around the table. Mandeep, are you calling this a frenzy yet when you see moves like that in ARM stock?
I think so. I mean, look, in this case, all of the stock move is not validated by earnings revisions. And as a fundamentals guy, you want to see that estimates go up and catch up. And, when there's a 90% move, and the estimates have been revised 2 to 5% upward, that tells you there is a lot that you are paying up for future earnings. And that too, who knows what the normalized level of earnings is. In the case of chips, what we have seen in the past is the supply tends to catch up. Look, NVIDIA definitely has a moat, we get it, but there is that supply component. Right now, every R&D resource is being invested into developing a chip that can train large language models. How long can they sustain that mode? And stocks are long duration assets. So you are paying for, 20 years forward in terms of earnings, which we don't know what the normalized level of earnings is.
Who do you think is behind this kind of move? Is it retail investors that are thinking we just want to get ahead of the next NVIDIA? Or is it fund managers who've been caught off sides and want to get even more bullish? Bull becomes bull in a world where everybody feels like inflation will come down and growth will continue.
I mean, there's both, actually. And the reason I say that is there is a fear of missing out that, okay, things have already gone up so much, and it hasn't translated into real revenues. We've seen that only 2 companies, yes, NVIDIA actually is showing that data center revenue growth, but we don't know if it's going to be the case for the next 10 years. And in the case of Microsoft, yes, they got a lift from AI revenue, co-pilots, but all others, including ARM, you have to ask yourself, where are the real revenues and how long it's going to take, for them to show up in the numbers? And I think right now everyone is chasing that because they know there is a clear catalyst, Fed funds rate coming down. Their tech stocks have a sensitivity to, interest rates, and that's part of it. And look, AI wave is real, but we are setting ourselves up for, a disappointment where the revenues don't translate as quickly as, the multiples are suggesting.
It's certainly real for NVIDIA. The numbers are a week tomorrow. What are you looking for from that name?
I mean, they have to beat and raise by at least 10%
Constantly.
to 20%. Even 2% or 5% is not enough because they've set expectations like that, for the past 3 quarters. And they may very well do that. But again, if you are investing in a long duration asset, you have to ask yourself, how long can they hold this moat for? And right now, the market isn't thinking like that.
They certainly did it all last year. Mandeep, it's good to see you. Mandeep Singh there of Bloomberg Intelligence. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bitcoin touched $50,000 for the first time in over 2 years. The latest rally has been driven by the U.S. approval of a spot Bitcoin ETF. The token tripled in value since the start of the year, but still remains roughly $19,000 below an all-time high. The U.S. Senate has approved a $95 billion bill for assistance for Ukraine, Israel, and Taiwan. But now the legislation faces an uphill battle in the House. Senators sat for an all-night session to debate the bill, passing it 70-29 early this morning. Republican leaders in the House demand that President Biden take action against undocumented border migration before passing any Ukraine aid. Voters in Long Island will pick a replacement for disgraced former Representative George Santos today. The contest pits Democrat Tom Suozzi against Republican Mazi Melissa Pillup. The race is viewed as a referendum on President Biden's policies. Snowfall across New York region could impact the turnout. That's your Bloomberg Brief. John.
Danny, thank you. We always say this, don't we? Turnout is so important. It's like the cheater's guide to political punditry. Turnout. Who's it more important for?
Well, it's important for both of them if you look at the makeup of this district, because there's so many voters who are not decided Republican or Democrats, and it's a swing district when you look down ballot, less as presidential elections. That is why everyone is focused on the snow today, Jonathan.
Turnout. The weather, turnout. I get that piece of it, obviously. Up next on the programme, making a case for aid to Ukraine.
The reason people should care about Ukraine is because, one, it's a pro-American, freedom-loving country. But two, listen to what Putin said. Putin said once he takes Ukraine, Poland and the Baltics are next. Those are NATO countries. That immediately puts America at war.
That conversation is next from New York. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
After 10 years, Joko Widodo is wrapping up a hugely popular tenure as president, and Indonesia will have its first three-way election in 20 years. Will Indonesia continue along Jokowi's path of free and active foreign policy, or will his successor lead the country in a new direction? Keep it tuned to Bloomberg for live coverage from Jakarta and all the results and analysis you need. Indonesia Decides. Coverage starts Wednesday right here on Bloomberg Television. Context changes everything.
CPI data 42 minutes away. Equities going into it negative here by 0.4% on the S&P 500. Yields coming lower by 2 basis points on a 10-year, 415.79. Under surveillance this morning, making the case for aid to Ukraine.
Our whole goal is to prevent war. That's the main thing. I mean, you look at Russia right now. The reason people should care about Ukraine is because, one, it's a pro-American, freedom-loving country. But two, listen to what Putin said. Putin said once he takes Ukraine, Poland and the Baltics are next. Those are NATO countries. That immediately puts America at war.
Republican presidential candidate Nikki Haley stressing the importance of support for Ukraine, saying it's only a matter of time until Russia invades a NATO territory and brings the US into the war. Here's the latest. The Senate passing a $95 billion aid bill for Ukraine, as well as Israel and Taiwan, setting up a showdown in the House. Joining us now is Leslie Vinjamuri, the head of US and America's program at Chatham House. Leslie, let's talk about the response to the comments from President Trump over the weekend. The NATO Secretary General obviously pushing back. Germany's Scholz saying Trump's stance is irresponsible and dangerous. To what extent do you think recent comments undermine the collective defense clause of NATO?
Well, it creates this tremendous uncertainty about where America's commitment to NATO is going, where America's commitment to transatlantic security more generally in this run-up to the election in November. And it's not helped, of course, by the struggle to get that, what's now called, I guess, a foreign aid package through the House. It's just passed through the Senate, as we've seen. But the antics surrounding that, I think, alongside Donald Trump's comments really unsettle European leaders, as they should. And, you know, some people have turned this into a conversation about pushing NATO members to get up to that 2% of spending on defense. That's, you know, a serious, significant, ongoing concern dating back to 2014, before Donald Trump. But the broader concern is, you know, we have a leading candidate, likely to be the Republican nominee, former U.S. president, saying that he doesn't care what Russia does to America's closest allies. It is dangerous and unsettling, to say the least.
Leslie, for European leaders, though, don't they feel like they've heard this before, whether publicly when he was former president or in those behind closed doors meetings, and view it as Trump using it as leverage to force European allies to hit their 2% defense target?
I think that nobody's certain what comes next if Donald Trump returns to the White House. There's a very clear sense in Europe and across the world, I believe, that Donald Trump in his first term was a man who didn't expect to be president, who had a lot of ideas and beliefs, who was scrambling from one set of administrators to another. But that as we look ahead to what he would do, that his set of ideas and that the 900-page document, Project 2025, that Heritage has put out, a future of a conservative America, which includes statements on foreign policy. This is a president who, you know, despite the fact that report doesn't specifically align with Donald Trump, it's clear that this is a former president, a future candidate who has a much more serious intention and plan for what he would do if he returned. He didn't pull the U.S. out of NATO. He talked about it. He created that uncertainty. But I think were he to be reelected, we would be looking at a very different president than we saw 2016 to 2020.
It also looks like he's putting a lot of pressure on a lot of Republicans right now in Congress to move away from aid to Ukraine. We did see it pass in the Senate very early this morning, but it's pretty much dead on the arrival right now when it goes to the House. Where do you see the U.S. assistance to Ukraine this year? Do you think this just doesn't get done?
I mean, I keep thinking that this gets done because what we know as we speak to members of Congress, and I mean members of the House, is that there is a majority, so we're told, the silent majority of members who would like to see this defense support continue for Ukraine. But the rupture in the Republican Party is truly extraordinary. You know, Lindsey Graham, who regularly travels to the Munich Security Conference, has said he's not going this year. That starts on Friday. He's going to instead travel down to the border. Mitch McConnell standing up and voting in support of defense of Ukraine. That is, one obvious example of the split in the Republican Party. But with, President Trump lurking in the background as a former nominee, putting that emphasis on border security, and quite frankly, not wanting to see a deal, wanting to play the role of disruptor in order to blame President Biden around something that's very serious. We know the problem of immigration is grave. It needs a solution. But it's really turning into a sharp point for the Republican Party. Will they be able to get that support through for Ukraine? It's very hard to see the path. I still believe that they will, but it's not, it's hard to map it out. We need some really clever people to figure out how that's going to happen.
It's a struggle. Leslie, appreciate your time today. Leslie Vinjer-Murray there of Chatham House on the latest effort down in Washington. With us around the table still, Jim Zauter of Apollo. Just a few minutes left, Jim, to have some final thoughts with you. You've alluded to this in the last hour, just how much finance has changed in the last 25 years or so. Can you walk us through what this is going to look like in the next 10? The shift from public to private, these flows that we've seen dominate, passive flows dominate of the last 10 years. What's this going to look like in the next decade?
Well, I think that the whole concept of open architecture, we were very much defined in the tailwinds of the last 30, 40 years, globalization, technology, lower rates. There's been a massive growth in the global financial markets that took place before the GFCs, post the GFC, lots of regulation and rules, but the monetary policy really had a massive impact. Now we're getting to a level set of the reality of the future. So I think it's going to be the large dominant players in capital formation and fixed income and alternatives in the equity in banks. They're going to play on a global stage, but it's going to be much more in an open architecture manner. People are going to partner with folks more than ever before. There's going to be an opening of how people think about alternatives and retirement savings. You know, you've seen what's happening in Canada, you've seen what's happening in Australia, we see what's happening right now in Mexico, recent travels of ours. So it will be, you know, much more longer-term retirement savings, guaranteed income, but there will be a lot more open architecture in all other sides of the asset management business.
20 seconds, who's your biggest competitor going to be in the next 5 years?
It's going to be a combination of our existing competitors today and partnerships that they create with financial institutions.
It's not going to name them, Bremo.
Come on, just for the panel.
Signpost them.
Yeah.
Throw in some banks there.
Just I want to know if it's, you know, banks, if it's, you know, different asset managers, or if it's tech companies. Is it going to be Apple?
I think, again, I go back to our structure. It's very, people like to talk about transactions or competitors today. You have to have a advantage of the products that you are delivering to people. At the end of the day, you can have great headlines and great ideas, but you got to deliver product. You got to deliver
some media drama, Jim. That's all. Jim, it's good to see you.
I'm here to invest.
Appreciate the hour. Jim Zauter of Apollo. Jim, thank you, sir. Coming up in the next hour, David Kelly of JP Morgan Asset Management, David Harrow of Harris Associates, Sarah Malik of Nuveen, Jay Bryson of Wells Fargo.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
The inflation problem is not going away. That will continue to create more and more risk of financial stability issues down the road.
I do see risks building that, could perhaps jeopardize this smooth disinflation.
Basically, every single investor pricing in a soft landing, which again gets me quite nervous.
All we need is a tiny whiff of less dovish data, and it, I think, would already be enough to send a bit of pain across all the asset classes.
If we were to get an upside surprise on CPI, then folks might say, wait a second, is this thing really overheating?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. Alongside Lisa Abramowitz, together with Anne-Marie Hordern, I'm Jonathan Ferro, 30 minutes away from a CPI report in America. And Lisa, we're looking for a two-handle on headline inflation.
And frankly, my takeaway from this morning is people are looking at it for an excuse to be more bullish, and that if you get an underwhelming or a downside surprise to the CPI report, watch out. It will be a rip-roaring rally, because that seems to be the tone that we're hearing from everybody.
So what are we looking forward today? Basically something in line, is in line a beat, just more the same?
It depends exactly where. It depends also how people are feeling. But honestly, kind of, yeah, because we're going to be dealing with potentially the lowest inflation read going back to early 2021, at a time where people are starting to sniff out maybe a broadening out, maybe not. I don't know. It depends on your bias.
Well, it's really important also to what's playing out at the White House in Washington, D.C. Their timeline is on their line, they hope. They continuously tout things like the Michigan survey, the Conference Board. People are starting to feel better about the economy. This, for them, is that last hurdle, especially when it comes to inflation. And they want to make sure that people are feeling better about their purchasing power, because the jobs market, the president will remind you today, I'm sure, when he gives out his inflation statement, has been unemployment under 4% for 2 years. But can they get over this final bump?
Amazing to see, sub 4% at the moment. Sub 4% is where the 10-year yield was on the last inflation print. This is where we are right now, north of 4% on a 10-year this morning. The scores look a little something like this. On the S&P 500, negative by 0.4%. Yields down 2 basis points on a 10-year, 415.60. That's the price action, the market mood. We'll get you a weather update for the tri-state area in about 10 minutes' time. We'll catch up with Danny Berger, so look out for that with Danny in just a moment. Coming up through the hour, David Harrow of Harris Associates looking ahead to CPI. Nuveen's Sarah Malik on concentration risk in the equity market, and JP Morgan's David Kelly on what today's inflation print means for markets. We'll be given the top story, counting down to US CPI, the crucial inflation report coming in less than 30 minutes. The headline number potentially dropping below 3% year over year for the first time since 2021. Equity markets in the United States near all-time highs, and hopes that maybe this rally can broaden out beyond the Magnificent Seven to things outside of the US, in Europe, and perhaps even Asia. David Harrow joins us now for more, the CIO at Harris Associates. David, wonderful to catch up with you, sir. Can we talk about the opportunity set beyond the Magnificent Seven into Europe and elsewhere?
Well, especially for investors like ourselves who focus on company-specific factors, valuation metrics, which is low price, high quality. At Harris Oak, Mark, it's a really good set of opportunities outside the United States, particularly in Europe, where, in essence, you can find high-quality businesses, 10, 11, 12 times earnings, sometimes 6, 7, 8 times earnings, yielding more than the price-to-earnings ratios, generating lots of cash, excess cash on balance sheets, free cash flow yields, low double-digit. I mean, all these valuation metrics for us are just happy hunting grounds, in essence. And
not just you, David. I'm going through some names. Novo Nordisk, GLP-1's a massive deal over the last 12 months. Everyone balled up on machines for chips, ASML, luxury players, LVMH. David, we've seen big moves in these markets. I want to be clear about that. As you know, the likes of the DAX and the Stocks 50 had brilliant years last year, just not as good as, say, the NASDAQ 100. David, can you describe the sectors, the kind of companies that you're focused on, if they're not these big headline-grabbing names of the last year or so?
Yeah, the headline-grabbing names are actually blinding investors from what's beneath those names. And take companies in Europe, the financial sector, major financial institutions like BNP in France, Intesa in Italy. These are companies that literally trade at 6, 7 times earnings, yield almost 10%, have excess cash, are buying back their shares at an aggressive amount. And everyone kind of forgets about these because they are being shielded or blinded by these theme stocks like the GLP-1s, like the semiconductor companies. Industrial is the same thing. If you look at the German premium automakers, BMW, Mercedes-Benz, both trade at about 4 or 5 times earnings and yield almost 10%, and again, have so much excess cash on their balance sheets that they too are buying back shares. So these are the types of businesses no one seems interested in. No one is focused on cash flow and valuations, which to us provides an opportunity, because eventually we'll come down to earth and we'll look at what makes a business valuable, and that's the cash which it generates.
Eventually we'll come down to earth and people will stop buying ARM and piling in on the heels of their earnings, but maybe not yet. David, love speaking with you. I do want to go to BNP because there was an issue with Credit Suisse, and I know that that was sort of one stock that you got fully out of after being a heavy investor last March. What did you learn from that episode that colors your investments in European bank stocks today?
First of all, in any bank stocks, what you have to do is be able to price uncertainty in some of their businesses, because you don't have clear transparency into the assets of every single bank. What you have to rely upon is A, the accounting, and B, the reputation and the quality of the management team. What we got wrong with Credit Suisse was we believed that at some point they would be able to turn around their investment bank. The other 3 areas of the business did just fine through the cycle. The private bank, the asset management, the Swiss Universal Bank. All the strengths in those 3 businesses were blinded by the ineptitude of the investment bank. Our belief was that if they could turn that around, if they could fix that, the other 3 businesses, then the light would shine on the quality of the other 3 businesses. With a situation like a BNP, we don't have any need for a turnaround in any of their businesses. This has been a historically extremely well-run company, a very good culture of risk, very good at growing. I think book value per share over the last 10 years has grown at over 7 or 8% per year. And today the company trades at just 2/3 book value. And like I said, it yields, when you add in the stock buyback, it yields well into the double digits. So you have to be careful and hope that they can fix something. Now, we finally sold out of Credit Suisse, started selling it at the end of 2022, because when they released their plan to restructure the investment bank, we thought it was an extremely faulty plan. So we thought, okay, after all this time, after all this hope, they're not going to be able to fix this. And by the way, the problems at the investment bank, as we know, by the end of 2022, we're finally starting to drip into those other strong divisions. David. So this is one of the lessons. If there's a bad division, it might be bad for a reason, and sometimes you just have to assume it's irreparable.
Was it a one-off? And this is something that we keep kind of focusing on. Or do you see other issues, specific concerns in other banks, whether it's in Europe or the US, that haven't been fully identified?
Well, was it a one-off? It was a one-off, I believe, in the greater scheme of the European banking sector. But like any company in any region, they will run into problems. Silicon Valley Bank, I would almost argue, was a one-off because they were so irresponsible on duration matching. You know, it wasn't a credit quality issue. It was this duration matching with assets and liabilities. They were so irresponsible. But many banks aren't so irresponsible, so you can't, I never thought it was systematic. I do believe it was more of a one-off in the Silicon Valley Bank and the other regionals who got caught up with the same lack of risk control. Same thing in Europe. There's a company like Intesa, BNP, Allianz, these are Lloyds. These are the financials we have that have never had major quality compliance risk issues. And this is what one has to look for, is the culture of risk control. Because in banks, this is number one. Risk is number one.
David, can we just finish by talking about your approach to investing? It was interesting, we caught up with Jim Zauter of Apollo in the previous hour. I'm not sure if you saw that conversation, but we were talking about passive investing over the last 10 years, just the explosion of it, and the bigger getting even bigger, with money just sort of indiscriminately going into equity markets and going into the Magnificent Seven, like they have done over the last 12 months or so. David, how would you frame things? I'd like your opinion on it. Do you see passive investing as the enemy to the kind of thing that you do every single day? What use is it if you find a name that looks great on paper, but nobody else notices and the money never comes?
Passive investing is an active investor's friend. And I say this because the weight of money going into passive investing means that money is just being invested in businesses, in essence, because they are there. This creates inefficient pricing of assets. Now, in the short term, and maybe even the medium term, you listened to David Einhorn, I think, last week, great investor, but he talks about the challenges competing against these people. Because the weight of money moves into this, and the stocks, that market caps get bigger and bigger and bigger. I mean, it reminds me of this old idea called portfolio insurance. As the stock price goes up, you buy more of it. Well, when cars go up, you don't buy more cars. When apples go up, you don't buy more apples. So when the price of businesses goes up, it goes against economic fundamentals to buy more of them. So in the long term, this creates opportunity for active investors to exploit these market inefficiencies. We also look a bit more volatile, because if we don't look like the index, we're varying versus the index. And sometimes our clients don't like that. But I think ultimately it creates market inefficiency, which is good for the active investor. But in the short term, it certainly isn't painless for us. Long only, boring value means weakness where we're invested in strength. Blown away by where the weight of money is going, where we may be invested where that weight of money is coming from, which means weakness where we're invested and strength where we're not.
I appreciate your response to that. One day we can do a round table, David, with you and Mr. Einhorn. We'd love to do that in the future. David, thank you, sir. It's good to catch up with you. David Herrer there of Harris Associates. Not the enemy, the friend. Passive investing is the friend of what David does every day.
It's sort of a matter of which stocks you're looking at, and it sort of matters what your investment thesis is. But this is basically how traders are trading now. It's around these baskets, and whether you basically use them to benefit you or not, this is sort of the way the new structure is playing out.
Without a doubt. Equity futures, by the way, we're negative by 1/3 of 1%. We are about 18 minutes away from the CPI print. More on that in just a moment. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A powerful winter storm is set to pummel the U.S. Northeast today, dumping heavy snow across the region. New York City public schools will hold classes remotely with as much as 8 inches of snow forecasted. Parts of northern New Jersey, eastern Pennsylvania, and southern New England could see as much as a foot. Hundreds of flights have been canceled into and out of the region's airports, according to FlightAware.com. A so-called fat finger trade is being blamed for a 7.1% decline by ASML shares in early European trading. Shares went into a 3-minute trading halt due to volatility. The drop for Europe's biggest tech company was its biggest on an intraday basis since October 2022. President Biden is forming a task force to address the mishandling of classified documents during presidential transitions. A special counsel report had found that Biden kept documents in his possession after he was vice president. White House officials called it a systematic issue affecting both parties. The task force will provide recommendations before the next presidential transition. And that's your Bloomberg Brief, John.
Hey, Danny, thank you. Up next on the program, we take a look at concentration risk.
Narrow leadership, even if it continues, it's not a healthy thing. It's making the S&P 500 and growth indices very, very concentrated.
That conversation up next, live from New York. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
was going to keep rain World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
Inflation data moments away, 8:30 Eastern Time, about 14 minutes away. Going into the scores look like this. Equity futures negative, 0.33% on the S&P 500. Under surveillance this morning is concentration risk threatening the rally.
Narrow leadership, even if it continues, it's not a healthy thing. It is still, after all this time, a tale of two cities where the mega cap tech companies are really the ones beating the earnings expectations, getting richer and richer valuations, leading the market higher and higher. It's making the S&P 500 and growth indices very, very concentrated.
It's the latest this morning. Bank of America says investors are loading up on big tech. The latest fund manager survey saying, quote, investor positioning is increasingly a headwind for risk assets, with global equity allocation to the tech sector hitting the highest level since 2020. Sarah Malik of Nuveen making a case for other areas of the market, writing this. Investors with significant exposure to the Magnificent Seven may want to consider diversifying. In our view, that calls for taking advantage of the opportunities in fixed income. Sarah, I'm pleased to say, is with us around the table. Sarah, good morning to you.
Good morning.
Let's just start with the risk, or at least the perceived risk. Why is narrow concentration in the equity market necessarily a bad thing?
Well, there's been two factors that have been driving the market this year, and that's earnings and the economy. And if you look at fourth quarter earnings, they've been heavily weighted towards technology stocks. The Magnificent Seven earnings growth is about 60%, while the S&P overall earnings growth should end at about 5% up year over year. So the question is, what's the catalyst from here, now that tech stocks are behind us, with their earnings. You know, what we're looking at going forward is higher for longer rates, less rate cuts than the market expects, a very heavy election year in 60 countries, in 77 countries with 60% of GDP going to the polls. All of that together is more headwinds for the markets when the catalyst of technology and their earnings growth is kind of behind us for now.
Your year-end call is basically where this market is right now, right?
It is, about 49.50.
You see very limited upside in public equity markets. Do you have a preference in terms of sectors at the moment beyond, say, big tech?
I think it's tough to bet against U.S. technology, but we need to be selective here. So companies such as Amazon, Alphabet, of course, the AI stocks are definitely more than hype. Those should continue to be the winners. But we think the market does need to broaden out. We are starting to warm up on real estate. Public REITs tend to do well in periods of interest rates where they're stable to cut. So that's an area that could perform well. As energy prices maybe continue to decline, material sectors that have been squeezed could perform well. And then, of course, fixed income over equities with equity valuations at a premium to history. They're trading at about 15% above their average. Fixed income looks compelling to us. Leveraged loans, which tend to do well during periods of stable interest rates.
So what scenario leads you to an underperformance on the index level, but a broadening out, which requires ongoing growth, and really a rally in fixed income, which has to do with cuts to interest rates? Is this sort of the sort of soft landing base case that you think is going to somehow hurt some of the biggest winners?
Well, in equities, our biggest concern is two areas. It's technicals and valuations. I mentioned valuations are above average. Technicals are also in overbought territory, not only for technology stocks, but for the S&P in general. That's what mostly concerns us with some of these headwinds going forward. Now, in fixed income, with all of this cash still sitting on the sidelines, earning maybe 4 to 5%, we think you can get higher total returns in fixed income going forward, so that cash eventually moves back into the markets, into lower risk areas like fixed income, where you can reach a little bit more and get more yields on your investments.
Are you talking about longer term treasuries? Are you talking about investment grade credit? Are you talking about high yield?
We like leverage loans and high yield leverage loans, which should perform well during periods of stable interest rates. And also we like high yield, where you can get a little bit more in terms of returns in high yield, which is a much higher quality than it used to be in past economic downturns.
No market conversation is complete without a conversation about commercial real estate. So let's go there. What are the concerns around that for you? Do you see that as an issue that just hits a couple of banking names and not everybody? Doesn't become a sector market problem?
Well, if you look at New York Community Bank, commercial real estate is at a much higher percentage for them than other banks. So we don't think that that will turn into contagion like we saw last year with some of the larger banks and regional banks. And also within REITs, we mentioned we like REITs, commercial real estate within the REIT benchmark is less than 5%. So there's areas that you can invest in within real estate to avoid it. Of course, at any time, though, you look at these banks, everything's digital. You could get a run on banks in general, but I don't think it's going to be a broad-based commercial real estate impact on these regional banks.
I wanted to finish on the consumer. 9 minutes out from the CPI report. 2 days later, we'll get retail sales in America as well. How squeezed is the American consumer? Because we've been told that repeatedly for the best part of a year, and seemingly we're still doing okay.
We'll get retail sales this week. December retail sales were very strong. I think that this week we'll see a little bit of a moderation, but consumers still spending. I think that's because of the trillions of dollars that came to the consumer during the pandemic and that era of low interest rates we had up until just through the pandemic. So the consumer hangover eventually will come, but we're not seeing any signs of it yet. With inflation, our concern is that the Fed has said they want to see broader disinflation before they start to cut rates. I think we'll see goods inflation continue to moderate in a few minutes, but it's super core inflation where we're worried that services spending, auto insurance, if that keeps going up, super core inflation is hot. That's not going to be great for the market.
Let's get a preview of that inflation number. We can do that with Michael McKee. He joined us now. Mike, the number 8 minutes away. What are you looking for?
We are looking for improvement. Of course, the month-over-month number for December was revised down to 0.2 in those revisions last week. So it'd be hard to see it going much below that on a month-over-month basis. But we are expecting the headline inflation number to come in at 2.9%, which would be the first time since 2001 that inflation on a CPI level managed to fall below 3%. We'll see continued progress, economists say, when it comes to the core rate, although it still remains fairly strongly above 3%. The issue is, of course, the Fed doesn't really look at CPI as other than an input into their discussions. They're going to focus on that PCE report we'll get later this month.
Mike, I am wondering in your conversations with Fed officials how much they're looking past this to retail sales and to more jobs data. In other words, this is considered backward looking and isn't going to give them what they're actually looking for.
Well, they are going to take this apart. The CPI is much easier to dissect in terms of the number of categories that it measures. And so they can find out if they're getting that kind of broad disinflation that they have talked about and you guys were just talking about. And so we'll look at that to see what kind of progress is still being made. But by their nature, all data are outdated. They're backward looking. The Fed just wants to see continued progress. And remember what Jay Powell said, we don't need to see better progress. We just need to see the same kind of good news.
Just more good data. Mike McKee, thank you, sir. We'll break it down with you in about 7 minutes' time. Sarah, can we just wrap it up with CPI? Where you expect inflation to come in over the next couple of months and ultimately when the Fed starts moving in a different direction?
Well, the key is going to be super core inflation, and can we start to see somewhat of a decline there? I think just looking at the number today, month over month, if it comes closer to 0.4%, that's going to be negative for the markets, higher for longer for interest rates. Markets aren't going to like that. Comes in below 0.2% month over month, I think you see a lower quality rally. People start to see perhaps rate cuts sooner. In between, I think we see more of the same of what we've seen year to date. Tech continues to lead. People stay a little bit more defensive, but generally that number will be mild. So we'll see how the markets react when we get the number.
Consumer confidence starts to pick up as well, Lisa. You do wonder what the psychological effect of CPI with a two handle might actually be, if it has any effect at all.
Well, it's clearly had an effect, or something had an effect, on the New York Federal Reserve survey of consumers that pointed to the lowest 3-year outlook for inflation going back to at least 2013. So sentiment is shifting. I wonder how much this is gasoline prices. I mean, really, how much this is just directly correlated with the fact that you go to the pump and you're seeing sub $3 barrel, $3 gallon oil. That is a game changer for a lot of people.
Wasn't that always the criticism of the UMich sentiment survey, that you'd call them up and basically they'd base their views on where the price of gasoline was that week?
If you map out the University of Michigan sentiment survey with the price of gasoline, it rhymes pretty closely.
You can do great things with political parties and UMich as well.
Oh, yeah, it's great.
Sentiment.
I love playing
Depends
around
on
with
who is in the White House. That depends how happy you are on the economy, which is kind of ridiculous, right?
But it kind of speaks to where we're at right now.
It speaks directly to where we're at
Which is a great place that we're going to keep talking about.
And you're really excited about the year ahead as well to talk about US politics through all of 2024.
You know, we're at a pivot point on many places, and I'm very excited to delve underneath the hood with a lot of it. Truly, it's a fascinating time, irritating in some ways.
I'm convinced. Sarah Malika Nuveen just happy she didn't have to talk about it. Sarah, thank you. It's good to see you.
Thanks for having me.
Appreciate it. CPI data is coming up next. Jay Bryson, Chief Economist of Wells Fargo, breaking it down for you. Inflation data just around the corner. Equity futures on the S&P 500 just a little bit softer. We're down 1/3 of 1%. The data up next.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Inflation data in America about 20 seconds away. The scores going into that data looks like this. On the S&P 500, negative by a third of 1%. On the Nasdaq 100, down about 0.7. In the bond market, let's slice and dice that Treasury market for you. 2-year, 10-year, 30-year, 10-year, 4.1482. Yields down 3 basis points on a 2-year, 4.44. We're down 3 basis points there as well. With your economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, you can see the frown on Jay Powell's face as the good news doesn't necessarily continue. CPI on a month-over-month basis up 0.3% year over year. That puts us at 3.1%. That's down from 3.4, but it's not the 2.9% that a lot of people had hoped for. The core rate comes in at a 0.4 rise, much higher than the 0.3 anticipated. That's a fairly strong core report. Leaves core inflation at 3.9% after 3.9% the month before. No progress there. So, John, you can give the scores. I'll take a look at the breakdown here and see where the problem is.
I'll get straight to it, Mike. I'm sure you can guess where we are. We're negative on the S&P 500. We're down by 0.8%. As we often stress after economic data, the first move not always the right one, but we'll see if this one sticks. The Nasdaq 100 is negative 1.3%. Off the back of hotter than expected inflation, yields are much, much higher at the front end. They were lower. The 2-year is higher by 10 basis points through 450 and close to 460 at 457.32. Yields are up at the longer end of the curve on a 10-year by 6 basis points, 424.95 on a 10-year. You push those moves through foreign exchange, you've got a stronger dollar and a weaker euro. We are negative on that currency pair by a third of 1%, 107.36. You put this data together with a strong payrolls print and decent wage growth. You put it together with a decent ISM services read and prices paid picking up, and you start to get a little bit more worried about maybe this Federal Reserve not being able to cut interest rates anytime soon. Lisa, I'd go back to that quote from Stuart Kaiser of Citi over the weekend and starting this week, that this CPI print has the power to toggle the storyline between soft landing and overheating. And here we are in the middle of February, and that conversation, I'm not saying it's running away with itself, I'll just say it's heating up just a little bit.
I think that that's what you see in the market. The idea of, just want to say, Earl Davis gets definitely a victory lap over at BMO Capital, where he was talking about shorting the 2-year. This sort of seems to edify that. But really the key thing here is, if you're not seeing a broadening out, how long does the Fed have to wait? In other words, not only is this not as good data, but it kind of flies against some of the progress, which is the reason why I'm curious from Mike, honestly, John, whether we're going to see an ongoing sort of acceptance of broadening out with this data, even though it's not as good as previous data, because if it meets the threshold for Jay Powell or not.
Mike, we can all read the headline numbers. Are you seeing that broadening out? Are you seeing that disinflationary trend intact? What do you see beneath the surface?
Basically, we see some of the usual suspects here. One of the biggest reasons that we saw CPI come in stronger than anticipated was housing. Housing costs, shelter costs up 0.6% after 0.4 the prior 2 months. And the same thing is true of owner's equivalent rent. So home prices still pushing up, rent prices still pushing up the CPI. Gasoline prices, as you'd expected, went down 0.9. So that's the good news. But food prices were double what they were the month before, up 0.4 after 0.2. So food is something that consumers will notice. And of course, housing is propping up the CPI rate higher than the Fed wants to see. Many other things are down some. Apparel is up only 0.1%, while used cars and trucks were down 0.7. So we are seeing some progress being made. Used cars and trucks, I'm sorry, down 3.4%, 0.7 decline for apparel. So we are seeing some progress in the areas that had given us problems in the past, but the big ones are still contributing to CPI.
If you just take a look at the market's response, people are ratcheting back expectations for a March rate cut, not surprisingly, now 17% chance being baked in. Mike, do you think that this is as bad for the Fed as it may seem in terms of moving in the opposite direction, or do you think that there are enough signs underneath the hood of some sort of broadening out that it gives them comfort to continue with some of the same rhetoric that we've heard from them?
I think you'll see the same rhetoric. It's not what was wanted or expected, but it isn't a reversal. We do see the inflation rates on a year-over-year basis for CPI going down. And remember that housing is a 1/3 weight in the CPI, where it is much smaller in the PCE, which the Fed follows. So I think they'll see this as progress, may be a little frustrating, but they weren't going to move in March anyway. And they'll get 3 more PCE reports before they get to the May meeting. So there's still plenty of time for this to turn around. What everybody's wondering is, when do house prices and rent prices start to go down, or do they?
Mike McKee, thank you, sir. Mike McKee breaking down the CPI report for you. Here's the headline for you. We come in just a little bit hotter than expected. Month over month, headline CPI, 0.3%. The number we were looking for was 0.2 in our survey. Excluding food and energy, we came in at 0.4. We were looking for 0.3. So that takes your headline year-over-year number to 3.1. The estimate was 2.9. The previous read was 3.4. Excluding food and energy, we come in at 3.9, bang in line with where we were last month. We were looking for 3.7. So let's push that through this equity market. Down hard by 1% on the S&P 500, negative 1.5% on the Nasdaq, and down 2 full percentage points on a small cap, the Russell, off the back of this move. Switch up the board and take a look at the bond market. 2-year yields a lot higher, a double-digit move, up 15 basis points on a 2-year through 460, 462, 61, up 11 basis points, 428, 48 on a 10-year. You push that through foreign exchange, yields up. Dollar stronger, euro weaker, euro dollar negative 0.4%, just about holding on to 107, session lows of 107.24. I think, Bramo, what Mike McKee just did there is really, really important. Does this inflation data change things for the Fed? Pause and bear in mind this. Or does it change things for this market and what it's priced coming into the year? The Fed coming into the year, the implied forecast from that dot plot, median dot, 3 cuts this year. The Fed had 3, the market was something like 6, 150 basis points of easing. We've been chipping away at that and chipping away at that over the last 6 weeks. And now looking at where we are priced at the moment for 2024, we're down to about 100 basis points. So we were asking the question, how do we close this spread between the market and the Fed? The market's coming down to the Federal Reserve. So does this change anything this morning? I'd say it changes something for the market. I'm not sure quite yet if this changes anything for the Federal Reserve, and whether that dot plot from the end of December, if they were to do one this morning, right now after this, would change all too much.
It's a great point, especially considering the fact that the Fed has been fairly consistent, albeit somewhat pivoting. The market lesson, though, is important here, which is which areas of the market are most leveraged to the idea of the Federal Reserve cutting much more aggressively than they've plotted out in their dot plot. And I'm looking right now at the Russell 2000 E-mini contracts that are down 2.4% at one point. Down hard. This has been the main obstacle to broadening out because there isn't conviction in a call that many people are backing away from. 6 rate cuts seems like too many for this market, and a lot of bets can't rally without something better being priced in.
Let's get you some reaction on the street. Jay Bryson, Chief Economist at Wells Fargo, joins us now for more. Jay, your initial reaction to that CPI print from about 8 minutes ago?
Yeah, well, so, John, obviously it's not good news. We would have preferred to have seen something a little bit less than that. But, I'd make 2 points here. And one, Mike made this point as well. A is that, the Fed is much more focused on the PCE deflator than the CPI. Weights are different in that. They think it's a better measure of inflation. And by that measure, inflation is lower than what we see in the CPI. And the second point I would make is the Fed is not going to make a decision based on one data point. They're going to take the totality of the data and they're going to look at it when they make a decision. Now, is a rate cut going to happen in March? Knowing what I know right now, probably not. But May is still a long way away. We still have a long data between now and May, and we'll see how the whole totality of the data pan out between now and then.
Well, let's talk about the totality of the data over the last 6 weeks or so, Jay. We had a pretty decent hot payrolls report. The ISM services picked up. Prices paid actually started to pick up as well. And manufacturing is really close towards getting into expansion territory. When we came into this morning, Citi Stuart Kaiser said the CPI number that we just got had the power to toggle the storyline between soft landing and overheating. Jay, how many data points are we away from having a bigger conversation, a little bit more of a powerful conversation about the prospect of this economy still overheating?
Well, I really think it's going to boil down to, again, getting back to the PCE deflator, that measure of inflation. In some sense, if you go back to the 1990s, right, we had, and I'm not saying that this is a Goldilocks sort of economy here, but we had very, very strong growth in the 1990s and very low inflation. At the end of the day, that's what's really mattering to the Fed right now. I'm not saying that the hard data don't matter, but what I'm saying is I think they're putting more weight today on where inflation is right now. And so, how many data points are we away from that? Well, between now and May, we're going to get 3 more prints on the PCE deflator. Come late April, if we're still running, north of 3% in the core PCE deflator, then we're not talking about the Fed cutting rates anytime soon. But, so that's kind of the way I'm looking at it in much more broader terms.
I am wondering, Jay, whether we're getting to the point of people questioning whether disinflation can continue without a greater weakening in the labor market. Right now, I'm looking at real wages coming in on an hourly basis at 1.4%, which is really one of the highest readings going back to 2021. How much does that have to shift before you start to see a little bit more of a broadening out in disinflation?
So if you look at the employment cost index, which we got out, a few weeks ago, on a quarterly basis, and then annualize that, that's only at 3.5%. If it stays at 3.5%, and we have trend productivity growth, that's consistent really with a 2% inflation rate. And we've gotten 2 really good productivity numbers in the last 2 quarters. Now, you can't make a lot of inferences off of 2 data points, right? And I think we need to see more of that. But perhaps maybe what's going on underneath the surface, and maybe I'm grasping at straws here a little bit, is maybe productivity is a little bit faster than what we think it is. And if it is, then you can have that stronger wage growth that's consistent with the 2% inflation rate.
Jay, when do we get out of this muddle and we get to something other than just people on both sides saying we're either heading toward overheating or we're going to head towards some sort of downturn? What's the threshold of understanding where this economy is in the post-pandemic reality?
Well, at least I still think we're dealing with, not so much the shocks of the pandemic, but we're still dealing with a lot of uncertainty as it relates to, the geopolitical situation right now. And when do we get out of this muddle? I mean, I wish I could tell you that. It's going to be quite some while, because I just think the underlying structural economy, whether it's productivity or things of that nature, with labor force growth, there's still a lot of volatility going on in that, and I think we're going to have a muddled picture for a while yet.
When you look at the balance of risks, do you think the market is accurately pricing in the risk of either overheating or some sort of more significant deceleration in the economy?
Well, so I'm not a stock market strategist, and so I'm not going to opine on the stock market. But it just seems that we came into the year with everyone expecting a soft landing, and it just seems like, in some sense, the expectation of the economy, whether that's priced into markets or not, again, I don't know, but the expectation of the economy right now seems to be for very, very good news. And if you don't get good news, like today, that's going to upset that, that narrative, at least for, some period of time.
Hey, Jay, good to hear from you. Jay Bryson there of Wells Fargo. The more I think about it, Lisa, the more I think just if you sat down with a Fed official right now, they'd probably turn around and say, I told you so. This is why we want to wait. This is why we want to wait.
This is why we're wanting to be patient. We have the leeway to be patient. And guess what? We are going to see surprises like this. We have a lot of data to look at, but we're not probably going to go in March. They can basically reiterate what they said already.
Which is basically what they've said repeatedly over the last few months. If you are just tuning in, let me wrap it up for you. So inflation data came out about 13 minutes ago, came in just a little bit hotter than expected, only 10 basis points hotter. But as you know, on Wall Street, that can be a big deal. 0.3% month over month was the headline figure. We were looking for 0.2. Excluding food and energy, month over month, we came in at 0.4. We were looking for 0.3. Year over year, hopeful that maybe we'd get a two-handle. You don't get one. 3.1% against an estimate of 2.9. Excluding food and energy, we stay at 3.9%. We were looking for 3.7. Equities, near session lows. We're down more than 1% on the S&P 500, down by about 1.6% on the NASDAQ. Lisa, you talked about a rough sort of small caps, down by 2.4% early this morning.
That highlights really how they're more leveraged to the potential for rate cuts than other asset classes. And it's frankly the reason why we haven't seen a broadening out, because until you see the whites of the rate cuts eyes, people aren't going to necessarily go into some of these other more leveraged areas.
I like that, Bramo. I like that line.
Thank you.
Let's turn to the bond market. Take a look at this. Double-digit move right across the curve. The 2-year out to about the 7. The 10-year yield is higher by 9 basis points. At the moment, up 11 or 12 basis points on the 2-year. 459.22, very briefly through 460. If you go back to the middle of January, January 11th, the last time we got a CPI report, the 2-year closed that day at 424. We've repriced yields higher a fair bit on a 10-year from 426.91 this morning all the way back to the middle of January. We were sub 4%, closing on January 11th at 396. Now, Lisa, in that period, the equity market held up pretty well in the face of yields repricing higher off the back of decent economic data, without a real scare that maybe we'd actually have to deal with hotter inflation prints. I just wonder how this changes the story and the connection to how the data speaks to bond yields and how bond yields start to speak to equity performance.
Right now, it seems like people are looking past to some sort of a significant degree whether we get a real resurgence in inflation, but I wonder how many people are going to kind of come to this idea of Citigroup, which is 1998 on repeat, and are we going to hear more of that going forward? That's going to be a key question.
Absolutely, the number one question. Let's get you a wrap of stories elsewhere. We can do that briefly with your Bloomberg Brief and Danny Berger. Hey, Danny.
Hey, John. The U.S. Senate has approved a $95 billion in assistance for Ukraine, Israel, and Taiwan, but the legislation faces an uphill battle in the House. Senators sat for an all-night session to debate the bill, passing it 70-29 earlier this morning. Republican leaders in the House demand that President Biden take action against undocumented border migration before passing any Ukrainian aid. Shares in JetBlue are higher pre-market. Activist investor Carl Icahn disclosed a 9.91% stake. Icahn is now JetBlue's third largest shareholder behind BlackRock and Vanguard. The stock fell 30% in the last year. Federal court struck down an alliance with American Airlines in a planned takeover of Spirit Airlines on antitrust concerns. Icahn says he's had talks with management about a board seat. And shares of Manchester United climbing today after billionaire Jim Ratcliffe said he'd extend his offer to buy a 25% stake in the club, pushing the deadline to Friday. In December, Ratcliffe said he would purchase the stake by allowing investors to swap 1/4 of their Class A holdings for $33 per share. That's well above the market price. And that's your Bloomberg Brief, John.
Danny, thank you. Much more on that hotter than expected inflation read. Up next, passing through inflation data.
It's not good news. We would have preferred to have seen something a little bit less than that. The Fed is not going to make a decision based on one data point. They're going to take the totality of the data and they're going to look at it when they make a decision.
That conversation up next with David Kelly of JP Morgan Asset Management.
Your a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
Live from New York City, under surveillance this morning, inflation data coming in hot.
It's not good news. We would have preferred to have seen something a little bit less than that. The Fed is not going to make a decision based on one data point. They're going to take the totality of the data and they're going to look at it when they make a decision.
Here's the latest this morning. Your equity market's negative 1.2% on the S&P 500. Yields are higher by almost 9 basis points on a 10-year, 426.72. And this dollar is stronger. With us around the table is David Kelly, Chief Global Strategist at JP Morgan Asset Management. David, good morning to you.
Glad to be here.
Inflation data 20 minutes ago. So the Federal Reserve said we need more good data, not better, just more good data. Was this good data or bad data?
Well, not the way they look at it. I mean, they're so determined to get inflation down to 2% as fast as possible. But from my perspective, all it says is, okay, the economy is cooling. It's just cooling more slowly. There are certain aspects of this report which push the numbers higher. But overall, as this year goes on, we think the economy is going to grow more slowly. We think inflation is going to come down on a year-over-year basis. And we've got 3.7% unemployment, 3.1% inflation. Now those two numbers together, they used to call that the misery index, but a misery index at 6.8 is not actually that miserable. So we should enjoy this. This is not bad. It's just cooling more slowly.
I'm not sure how many people are enjoying it this morning, but we can get into that in a moment. The dot plot implied maybe 3 cuts this year at the Federal Reserve. The market was closer to 6 to start the year. Do you think this is a bigger game changer for the market than it is, say, the Federal Reserve?
Well, I think people were always misinterpreting what the market was saying, because what the market was saying was really a weighted average of 2 scenarios. One where you don't have a recession in which the Fed can do these three rate cuts, or 2, you have a recession, they have to cut 300 basis points. And and what's happened is these data that we've had early in 2024 have really pushed the possibility of a 2024 recession. That possibility has been getting smaller and smaller. And so I do expect we're going to see a reaction in the market to that. The market may still have more than 3 rate cuts this year, and we're still thinking we'll avoid recession, so 3 rate cuts is what we get.
It's a fascinating way of putting it. I like the way that you're talking about the 2 poles and how this really is sort of a Goldilocks or at least strength kind of situation. What's your investment response to this, given the fact that the market has been perhaps more aggressively pricing a downside risk that's now getting pushed out?
Well, yeah, it does mean that you buy bonds for income and diversification. You do not buy bonds for capital gains. A whole generation of investors got the idea you buy a bond fund, you make a capital gain. And no, you don't. There's nothing wrong with 4.25 on a 10-year treasury, given an inflation rate which is slowly coming down to 2%. So we don't expect much of a capital gain there. We wouldn't necessarily be overweight fixed income. These look like reasonable levels. For the equity market, it's still, I think that the important thing is the scenario is continuing. This soft landing is continuing. There's lots and lots more runway. We don't run out of runway here. So we can just keep on slowing inflation down, keeping the economy. As that happens, I think that helps people, helps move money still into the market. And the market, PE ratios don't stop at the limits of prudence. They stop at the limits of exuberance. And this market is getting expensive, but it doesn't mean the party's over now.
I guess I wonder if this is such good news for the economy, why Russell 2000 stocks aren't performing better, why they are performing worse in the face of this data and the suggestion that the Fed isn't going to cut rates more aggressively.
It may be a timing thing because the mantra everybody has heard is when you buy small caps, in a recession. When's the recession? Oh, not for a while yet. So you got that. So it doesn't, the timing doesn't sound right. And then also, you've got a lot of regional banks in the small cap arena. They're getting hurt. You've got a lot of unprofitable companies. And the market cap of the top 10 stocks is enormous, but their share of earnings is also pretty high. It does seem like money is all floating to the top in terms of market cap here, and that's not terribly helpful for small caps.
I wanted to spend the few minutes we had left with you going through your thinking and your framework for the economy, because I do think it's quite original. It's different to what we hear from a lot of economists on Wall Street. You put less emphasis on the Federal Reserve, just in terms of the economy going through this process of self-healing, readjusting and bringing inflation down. Do you think we talk about the Federal Reserve too much with regards to inflation?
Yes. I think the Federal Reserve has got a very big impact on financial markets and a very small impact on the economy, actually. The Fed will be celebrating, we managed to bring inflation down from 9% to 3%, but did they? The only mechanism by which they could have done that was to reduce aggregate demand. But we saw GDP growth of 4.9% in the third quarter, 3.3% in the fourth quarter. There is not the slightest scintilla evidence that the Federal Reserve has actually succeeded in slowing down the economy. If it didn't slow down the economy, it can't take credit for lower inflation. The economy did that itself.
And you expect us to get back to 2% with that process just continuing?
Yeah, we do have some technical. We've still got auto insurance up 20.6% year over year. And we know that new car prices have stopped rising. We know that auto repair costs are rising much more slowly. This thing's got to crack. It's taking its time, but it's got to crack. And also with shelter inflation, we know that rents being negotiated at the point of rental aren't going up that fast. So we know that's going to crack. So these two technical factors, if you look at auto insurance and shelter, they're 80% of the year-over-year increase in CPI. Yeah. They're going to come down, and that means that from a technical perspective, you can get down to 2%, even if the rest of inflation is kind of sticky.
This begs the question, if they really only influence financial conditions and they're not influencing the direction of inflation, how on earth should one on the Federal Reserve Committee right now set interest rates? What should they set them for?
At a normal level, which will not cause financial market booms and busts, because what they've done is they've caused tremendous distortion in financial assets, in real estate, by pushing rates way too low for way too long and now jacking them up and leaving a whole generation of Americans unable to buy a house. So stop it already. Get back to a normal level. Practice your golf game. You don't need to do all this stuff and just wait for the next financial crisis, or just when you're actually needed, not to micromanage the economy.
You mean less speeches and more golf, maybe?
I think the economy would do better.
David Kelly, thank you. David Kelly of JP Morgan Asset Management. CPI coming in a little hotter than expected. Equities down by 1.2%. Bond yields are higher. Tomorrow, this conversation will continue. Russ Kostrick of BlackRock, Sarah Wolf of Morgan Stanley, Deepak Puri of Deutsche Bank, and David Rubenstein of the Carlyle Group. That and a whole lot more. From New York City, for our audience worldwide, and for our audience in the tri-state area, stay safe as the snowfall picks up, Bramo, and the kids enjoy a snow day.
Actually, you know what? They really are, because there are technical difficulties. Yes.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
in destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to
about
do?
the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From snowy New York City for our viewers worldwide, a very good morning. I'm Manus Granny in for Jonathan Farrow. So we've had a little bit of a shakedown on the CPI, and it has ripped the underbelly on the upside of these equity markets, with the breath taking the head down 3.2%. The countdown to the open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Up on the show, that CPI print coming in hotter than expected. What does it mean? Sends equity futures lower, treasury yields higher. Traders continue to cut back their rate cut expectations. We begin with the issue of the day, inflation prints in the USA.
Obviously, it's not good news. We would have preferred to have seen something a little bit less than that. The Fed is much more focused on the PCE deflator than the CPI. Weights are different in that. They think it's a better measure of inflation, and by that measure, inflation is lower than what we see in the CPI. The Fed is not going to make a decision based on one data point. They're going to take the totality of the data, and they're going to look at it when they make a decision. Now, is a rate cut going to happen in March? Knowing what I know right now, probably not.
Those rate cuts keep getting pushed to the longer grass. Let's get to Mike McKee. Mike, your takeaway on this, it is all about not getting a sub-3 print. Give us your interpretation.
Yeah, there's still progress being made, Manus, but it's not the kind of progress that Jay Powell said he's looking for. Instead of a broad-based decline in prices, or at least in the rate of inflation, what we saw are some big categories that pushed it up. And as you can see, headline inflation up 0.3, core up 0.4, both a tick higher than anticipated. And that headline does not come down under 3% as people had hoped. Housing, rent, and food both, or all three rather, were were basically much higher than anticipated. Housing and rent come in up 0.6. Food doubled, up 0.4 from 0.2 in the month of December. So overall, that is not good news. We did get a big drop in gasoline prices and used cars and apparel as anticipated, but it's not enough to offset what we saw. And you can see the impact of what's been going on when you look at our ECAN function on the Bloomberg, and you can see how much more services contributed this month to the overall inflation levels. And the blue there is food much bigger than it has been in previous months. So that's going to be the thing that the Fed is looking at, taking this all apart to see where the inflation still is. And unfortunately, it's in the areas that they can't necessarily do so much about. You were right, Manus, though, about one thing, and that is we have pushed out the odds of a rate cut. Now, the markets don't think we will have a rate cut until June. It was anticipated for March, and then, of course, we pushed that out to the May meeting. And after this CPI report, it is now June, and we're down to 4 rate cuts this year from 6. So the market's starting to move towards the Fed's position. And at this point, I don't think you can really pick a date for a rate cut. There's still too much in flux.
Yep, the market is certainly readjusting live, and as we speak, that spike in the 2 years, and indeed, the betting now is that we move further into the back half of the year for rate cuts. Mike, thank you very much. Mike McKee bringing us the data. Let's take the conversation to PGIM's Robert Tipp and PIMCO's Aaron Brown. So here we are. I look at the data. The Fed may well be disappointed that the core number on the headline is not sub 3, but they're going to probably welcome the fact that the market has been brought to heel. 4 rate cuts. Pre-Christmas, we were at 7. Here we are at 4, and only a 40% chance of a 5th one. Robert, do you think that they'll welcome the shift in the market, but be wary of this respike?
Right. Well, I think the Fed has had the right narrative, and the market has at times the wrong narrative. The market was looking for a return to secular stagnation, had a 3.6 Fed funds rate for January of next year priced in, way ahead of the Fed's 4.6%. I mean, that appears to be the market's de facto habitat mindset, that we're going to go back to target inflation, soft growth. But the Fed is monitoring the reality, and the growth is really solid. The inflation is more of a last mile phenomena, where that last mile of getting down to target after rapid deceleration is proving to be a little bit chewy. And so the Fed's dot of 4.6%, the market has not even quite come back to where the Fed has expected to be. So I think that's why the market is adjusting. I think the Fed, they would like to see a better number, but it's not a terrible number.
Okay, I like your take. It's getting a little bit chilly. Aaron, good morning. Good to see you. So here we are. You know, how disruptive is this spike in inflation? I mean, if you listen to David Kelly just before we came on air, it was about the auto insurance and it was about the shelter component that caused these real underbelly of the spike.
So I do think that this does complicate the messaging and the decision-making for the Fed. Remember, as recently as a week ago, a number of Fed speakers spoke, pushed back on the market's expectation for Fed cuts, and were really guiding the market to more of 3 rate cuts this year, you know, maybe a little bit more than that, not what the market had been expecting, which was elevated relative to the Fed's expectation. So I think that the Fed has been trying to guide the market narrative to expecting less this year, but the market still, I think, was ahead of itself in terms of pricing, not just across bond markets, but across equity markets as well. You saw last week that some of the most beaten up, highest short interest names, you know, rallied pretty strongly last week on the expectation that we had good growth, but that the Fed was still going to have this very dovish narrative. And I think you're going to see that come out of markets this week, you know, certainly following this print and unwind. And so I think some of the market movements that you're seeing today is just an unwinding and disruption of this very soft landing theme that's a narrative in the market.
Yeah, I mean, one could say it's a moderate interruption or perhaps just a reality check. The red headline is that the swaps market has shifted to July from June for the first full cut. Robert, this plays to your narrative, which is a slow go rate cutting cycle. If it's slow going, and perhaps now in the camp of 3 to 4 rate cuts, and that's assuming that the market overreaches now to the downside, which is to take us to the level of the dot plot. What does that do to risk?
Sure. Well, obviously, this wide fluctuation where the market wants to expect the Fed will be, cutting more aggressively into the 3s, but the reality is that they're cutting into the high 4s, creates like a ping pong phenomena where, to the extent that the data, one print, aggressively, supports one end of the spectrum, where you could ping pong back and forth. But I think, generally speaking, big picture, when you look at the huge swings that we've had with interest rates going from a 0.5% 10-year all the way up to 5%, we're in a relatively range-bound situation. So I think we are going to have volatility. It's going to be more intermittent. It's not going to be a major systemic shift in overall levels of markets here.
Aaron, this plays to your theory, late and less, but I'm drawn to the extrapolation that you make, which is they may be late and less, but then when they come, it's like all good things in life. It'll last longer. It'll be deeper than the market currently expects. So how late will they be? And then how deep do they have to go? Because that says to me that maybe they have to cut more for all the wrong reasons rather than disinflation. It's more about a slowdown. But is that over-extrapolating your thesis?
No, I don't think so. I mean, the higher for longer theme or thesis really does mean that it does create more risk of a recession, or at least of a more pronounced economic slowdown, the longer that rates remain high. And so that certainly is the risk. And I think that the market has sort of priced out that tail of a recession. And I think that that's probably misplaced. And so we do have to be cognizant that you are seeing pretty big divergences right now in the real economy, as well as in equity markets, in terms of how the large caps that have ample liquidity, easy access to capital, can issue in the bond markets, can issue in the equity markets, are doing really well. But the small caps are not doing as well. And this is a reflective of the general economy as well, as where there's a big divergence between the haves and the have-nots in the market. And so the question is what's really driving, equity markets, and what's driving the economy. So I do think that as we, push out rate cuts rather, and as we, persist at this higher rate, those companies that are, the most vulnerable and need capital the most are going to come under increasing pressure.
Do you think, just to continue that thought process then, Aaron, do you think that we're going to see more injuries like the regional bank disruptive moment that we had a couple of weeks ago? Are there going to be other small canaries in the broader minefield?
So I do, and I think that that's one of the big risks out there for the market. I don't think that these are going to present systemic risks and take the entire market down, but I do think that you're going to see these intermittent periods of disruption, not just from other regional banks, but from other sort of small cap sectors that are highly leveraged, that have really depended on the last decade of liquidity, and now have rolling maturities that they're going to have difficulty refunding. And so there will be casualties along the way, and I think the most distressed parts of the market are going to be sort of the epicenter of those casualties, which is why in our portfolio, we have a real up in quality bias right now in terms of how we're positioning across credit and equity markets.
Robert, this is a salutary reminder to anybody out there that goes back and looks at the follies of cutting 1986, 1987, and then of course you had the LTCM. So we have this lovely bond piece out that traders should be wary that the Fed may well have to raise rates after they initially cut them. Do you subscribe in any way to that thesis? Do you think it is right to look back at 1986, 1987, to look at the LTCM crisis of 1998? Do you think that that has merit, or is this just such a different economy?
Well, I think this is a mid-90s kind of environment, which is very positive. The Fed hiked from 3 to 6% between February 94 and January 1995. And then they cut rates in 1995. They raised once in 97. They cut in 98. They raised in 99. But they were all small 75 basis point or less cycles of fine-tuning. And I think that is a big positive, ultimately, for the bond market and for credit product here. I think for investors that lock into pretty high yields at this point where central banks are done raising rates, they're going to reap the benefit of that. And the fact that rates are high and that the Fed is going to be very slow to cut, since they think the neutral rate may have risen, is going to afford them the latitude to cut if they need to avoid a recession. And that's one of the problems that we had back in the secular stagnation era. They were running so close to the effective lower bound that they had to resort towards their least effective non-standard measures once they reached the effective lower bound to accommodate. Now they're going to be up at a high level of rates. We have a shortage of housing. They should be able to easily cut rates a bit at some point and stimulate growth. So I think it's going to ultimately be a big positive for the economy and help people to earn these high yields.
Well, they have got the bullets in the gun, so to speak, if and when there is an incident where they need to react in a timely and even aggressive fashion. So with that in mind, we'll square that away for now. Robert, stay with me. Aaron, stay with me. Robert Tipp, Aaron Brown, my guest this morning on the CPI, the hot print out of the CPI. Let's look at the repercussion under the hood of these equity markets. Abigail Doolittle is with me. So a broad sell-off, Abby, but tell me a little bit more about the nuance.
Indeed, it is very severe. And first, I would like to point out some of that broad sell-off only because it's pretty extreme. For the Russell 2000 futures, we're looking at the worst day potentially since September of 2022. For the S&P 500 and the NASDAQ, both down close to 2%. It's the worst day of the month, but that Russell 2000 down 3.5%. Dragging on the bigger indexes, though, take a look at ARM Holdings. After a massive rally, investors rethinking that, down 13.7%, having to do with the reality of their AI chip. From a technical perspective, this consolidation is healthy, and some of the rally may in fact hold, but today certainly weakness on that CPI print, taking away some of those animal spirits in that risk-off mood. Doing the same for Advanced Micro, another AI chip company. Take a look at Microsoft, big tech, down 2.4%, because of course the idea that they won't be cutting potentially the Fed until July, that means that liquidity is still not as abundant as maybe investors would like. That puts the spotlight on valuation. And even for banks, Bank of America down 1.7%. Not a lot of places to hide today, Manus, except for some of those idiosyncratic earnings stories that we will, of course, be taking a look at.
Indeed. Abigail, thank you very much. And just look at that ARM pre-market up roaring through last night and giving it back this morning. Okay, coming up, investors are parsing these earnings for insights on, you got it, the U.S. consumer.
Narrow leadership, even if it continues, it's not a healthy thing. It's making the S&P 500 and growth indices very, very concentrated.
We take a look at the heavy hitters who reported before the bell. That's next on Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Narrow leadership, even if it continues, it's not a healthy thing, is still, after all this time, a tale of two cities where the mega cap tech companies are really the ones beating the earnings expectations, getting richer and richer valuations, leading the market higher and higher. It's making the S&P 500 and growth indices very, very concentrated.
Perennial conundrum for everybody, the breadth of leadership. It is earnings season. We march on. And the latest results provide insight into the U.S. consumer and how corporate America is dealing with the lingering pricing pressures. Shopify earnings missing the mark, warning that higher costs could continue to eat into the profits, sending their shares lower by 13%. Also, that hotter than expected CPI number this morning could disrupt all the betting, and it has disrupted all the betting on when the first rate cut will come. Abby, run me through your first take.
Well, you know, in terms of this hot CPI print, that is obviously creating a risk-off mood for investors, really a sudden halting of the rally that we've seen relative to especially the mega cap stocks. But we've seen some broadening, but now we're not seeing it in earnings results because it's not just DWS and David Bianco there who is a little bit concerned about the breadth of earnings. Bernstein's also saying that relative to the consumer, the all-important consumer, 2/3 of the economy, that they've come in a little bit light too in terms of some of those earnings that been a mixed bag. That's certainly true this morning. With the exception of Coca-Cola, they of course put up a good quarter. Some of the other consumer stocks that we have coming out this morning in terms of earnings, not so good. So for Coca-Cola, their organic revenue view was higher relative to the street. The volume versus price mix was good. Shopify, though, that e-commerce story, so not true staples, but certainly a consumer-based company in an indirect way. Their fourth quarter results came in better than expected, but after a 90% rally, the margin guide is really worrisome to some folks, suggesting that the pricing power is there. A real consumer tell, Marriott, so this stock is down. They did beat adjusted earnings by 68% to speak of pricing power and margin power, but they missed fourth quarter sales by 2%. There's a soft guide. And then finally, if we put it together with Hasbro, that stock is down after being down significantly over the last year. The demand for toys just not coming in. It's weakening. Sales missed. The earnings were missed by 41%, soft annual outlook. So I think that now maybe, Manus, in terms of all of these results of both big tech and some of these broader companies and this CPI print, maybe the idea of no landing, that's out of discussion. Certainly we're back to the soft landing. And then is it that hard or rough landing? Is that going to be back into the equation? Let's stay tuned.
Yep, maybe I'll get a Marriott hotel room at a reasonable price. Abigail, thank you very much. Abigail Doolittle with the stocks on the move. Robert Tipp and Aaron Brown are my guests this morning. Aaron, just in the break, the three of us were just having those sort of squash moments of conversation. I'm drawn to your comment, which is, well, you know what? Unprofitable tech got a little bit of a wake-up call. You get this adjustment in rates, and it's quite a spiky adjustment in the short end of the curve. But maybe it's not such a bad reminder and creates pockets of opportunity. If you're not in on the Mag 7, if you're not in on those bigger beast trades, maybe this drawdown is actually just a bit of air coming out of the tires, and it's not that bad to have unprofitable tech take a smack.
No, I think that's right. I mean, I think particularly last week, we saw names get really ahead of itself. And actually, that was a continuation of what we saw in the fourth quarter of last year as well, where some of the more heavily short interest, more value-oriented stocks did quite well coming into the close of last year, continued a little bit into last week as well. And you saw these huge moves in stocks that probably did not have that fundamental underpinning for the types of advancements that we saw. When you look at earnings seasons this quarter, it really is this divergence between the tech plus sector, which has delivered earnings, upwards of 38%, and the rest of the S&P 500, which has very middling returns. In fact, the cyclicals in aggregate delivered earnings year on year down 9%. A lot of that is being driven by the energy sector, but even stepping back from that, revenues across the board were relatively weak. the more service-oriented sectors did a little bit better outside of healthcare, but you're still seeing this market where you have one sector like the tech sector, which is up 40%, and you have another sector like healthcare, which delivered earnings down 20%. It's a huge bifurcation in the market right now, and I think that really presents a lot of opportunity for equity investors.
Can I just tell you this? You know how to see the top of a market. Today, technically, I'm deploying the rest of my pension fund from the Middle East into U.S. equity markets. That's how you both know. This is actually a near-term top. This is the most single devoted contrarian indicator to any investor out there at the moment. Let's just put that in. I don't know what portion goes into credit. I don't have anything to do with the allocation. But Robert, this must be one of those moments. You look at those credit spreads. They were squeezed so beautifully, weren't they? Is this a reminder that tech can, or sorry, that credit could be in for a little bit of a shuffle and maybe a backup in yield in the spreads?
Yeah, I mean, honestly, that's the least of my concerns if I was looking at the markets from a macro perspective. Yields, even after the decline, are back up at pre-financial crisis levels. Whether you're looking at single B high yield, whether you're looking at the overall aggregate index, you've really revalued. Your real yields are at an attractive level. By contrast, equities, they're, I mean, in their worst quintile of valuations over that period. So you've seen a tremendous revaluation between the two. People can make the case that cash yields are quite high here, but those may prove to be transient as the rate cuts eventually kick in. So, you know, it's been a tough slog during the secular stagnation of where fixed income had a big pickup to cash, but it wasn't attractive to equities. Now I think those valuations on a relative basis have switched in a big way in favor of bonds.
Okay. Well,
despite the credit spread tightening. Yeah.
Okay. Well, they are mighty tight. Maybe it is the backup in yield is the opportunity to load up there. Team, thank you very much. Robert Tipp, Aaron Brown on the markets. Coming up, your morning calls, and we've had that hotter CPI print. BlackRock's Jean Bovin joins me after the opening bell, I should say. What it means for markets. What's he worried about? Good morning from a snowy New York.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock. Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
CPI print causes the bond market to reprice up 12 bips on the very short end on 2-year paper. That unseats the equity market narrative. These rate cuts have been bounced from March to May to June. Now we're talking about the summer of July. Morning calls on the street. Redburn Atlantic downgrades United Airlines to neutral, pointing to a muted demand for air travel. Daiwa downgrades PayPal to neutral, expecting tepid earnings growth for the foreseeable future. And finally, B. Riley downgrading Children's Place to sell, citing lackluster results and a growing cash concerns. Coming up, we'll dig deeper with Jean Bovin into the implications of that hot CPI raid on Bloomberg.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity traders don't have much to applaud about today because for now it's about an interruption in the projection of the inflation, the disinflation narrative, and that no landing gets pushed further into the long grass. Equities take a little bit of a touch on the downside. It is about the Russell 2000 taking the biggest dip of all, down 3.2%. There is the opening bell. Equities are lower. There's narrative here which is pushing rate cuts further out into July now. If you just think, as Abigail was saying to me during the break, we started in March rate cuts just a few weeks ago. We're now down to July and a 40% possibility of a fifth rate cut. So 4 cuts now priced in. That emboldens the dollar. It causes the euro to drop by 0.5%. 10-year yields are up by 8 basis points. The short end of the curve is where the monster moves are by 11 basis points. So a slight flattening there. And oil up by over 1%. The OPEC Secretary General, Haytham El-Gaith, says that its peak demand looks very far out. They see robust demand in China. They see very robust demand in China and phenomenal economic growth in India, according to El-Gaith. Okay, let's talk about stocks under the hood. JetBlue, the activist investor Carl Icahn revealing his stake of just under 10%, with the plans to seek at least one spot on the board. What are the implications, Carl Icahn, on your board? in the airline industry. Abby, what have we got?
Well, it probably has some people quaking, but for stock investors, they're really liking it. We're looking at the best day for JetBlue, a bright spot on this rough tape day so far on that hot CPI print. We're looking at the best day in about 2 months. And this, of course, as Carl Icahn does announce, that legendary investor, a 9.1% stake, plus what you were talking about, eyeing a seat on the board. He's really looking, apparently, to boost shareholder value in the wake of the nearly collapsed deal with Spirit Airlines. Now, their position is just above $200 billion. That's the third largest for the carrier. So this is a significant position and reason to think that there could be some big influence here, putting pressure on CEO the new CEO, I should say, Joanna Garrity, who will be evaluating steps to return to profitability as a standalone carrier. But that's not the only bright spot in the travel space, Manus. We also have TripAdvisor, also related to a potential deal. And this stock is up more than 10% right now, up about 12%. This, as they have announced a special formation to consider deals, a special committee to consider deals. Now, Cowen does not see Booking.com, Airbnb, or Expedia as potential bidders. They're saying from a sum of the parts position, it would be a $25 stock. That's right around where the stock is. Another analyst over at Jefferies wants to know if these talks are already happening or if they're going to be new. Relative to both of these stocks into today, JetBlue had been down 28% over the last year. TripAdvisor down a little less, down about 8%. So today, we have a balancing of the scales for these travel-related stocks.
We have indeed. And Marriott, of course, as you told me earlier, had a little bit of a touch lighter. Abby, thank you very much. Let's turn to the semiconductor industry. Shares in ARM Holdings moving lower. That's after a 4-day run that sent the stock to a record, a closing high. Ed Lowe is with me. And yesterday was pretty stunning for ARM, wasn't up 29% yesterday. So what changes this morning? Is it just a little bit of exhaustion? Ed, good morning.
Yeah, good morning. A little bit of exhaustion, an assessment of the risk you're willing to take on a stock where the rally has driven it to a place where it's trading at 40 times forward 12-month revenue projections. Since Wednesday after market, when ARM reported earnings, the 3-day rally added a 93% gain to the stock, or in other words, it added one PayPal's worth of market cap to its value. We are down 10% now on the stock, trimming some of those gains. The question for the street is, even if you're bullish, how much further can this run? And there is a misunderstanding in the marketplace about what ARM is. ARM is not an AI chip maker. It is a chip design firm that has two parts to its business. A royalties-based business where it charges a royalty or commission if a company has used its blueprints or design blocks for a semiconductor, and it has a licensing business as well related to the underlying code that allows a semiconductor to communicate with the software that's intended to run through it. It does not make AI accelerators, which are the high-performance GPUs NVIDIA and AMD kind of dominate the market for. But the AI story is clearly there. So when you look at the revenue projection for the current period that has the street really excited, it is that licensing growth that is pushing the needle here. And what they're experiencing is the broader impact of AI infrastructure investment, the other chips away from AI accelerators that go into building out server farms and data centers. The one thing I reflect on is when I spoke to ARM's CEO, Rene Haas, on Thursday, he told me that this is in no way an AI hype cycle. This is real. How real it is, though, in terms of their top and bottom line growth, that's the assessment the street's making this morning as that sizzling rally halts.
Well, it is stratospheric, isn't it? I mean, tripling since the IPO. And I like the differentiation that you make in terms of the CapEx, which is intellectual CapEx, perhaps rather than industrial CapEx, where they have the exposure. Thank you very much. Let's turn on to the rest of the earnings. Coca-Cola reporting better than expected results, back off higher prices. Isabel Lee joins me now. Everybody in this sector being able to get away with raising prices, but they haven't been able to get away unscathed in doing so, Isabel, have they?
That's the thing. This is a story of how much Coca-Cola can still increase prices, because basically the story of the quarter was how higher prices help Coca-Cola overcome a volume decline, especially in North America. We have the beverage giant forecasting organic growth revenue of 6% to 7%. That's above estimates. So we also have Coca-Cola reporting fourth quarter organic growth of around 12%, which is also above estimates. So this was boosted by the likes of Mexico and Germany. Growth there was good, but not in North America. And Coca-Cola said that the increase in prices was 9% in the fourth quarter, which is more than what analysts expected. So pair that, Manos, with Coca-Cola reporting a volume increase of only 2%. So that also fell short of analyst estimate. North America case volume declined by 1%. And last week we had PepsiCo reporting also the same thing. They saw a decline in North America, but to them it's around 6%. So to your point, how much more can companies keep on increasing prices without driving customers away? We have analysts saying that PepsiCo and Coca-Cola have to do better when it comes to their case volumes. And ahead, we have Coke anticipating a 4% headwind when it comes to their currency exchange rates, when it comes to comparable revenue. And also ahead, we have Coca-Cola releasing a new permanent flavor, and that's called Coca-Cola Spice. It's a raspberry flavor drink, Manas. Shares are up 1.5%.
There we go. Raspberry Coke. We've tried a couple of variations on Coca-Cola over the years. Isabel, thank you very much. Isabel Lee on Coca-Cola, stock up 1.34%. Now, Marriott topped their estimates in terms of the company benefits from increasing demand outside the USA. Alex Semenova is here to break down the details. The stock's down 5.5%. Why? Is it because of the outlook? Where's the weakness?
Yeah, very interesting here, Manis. Despite this reaction, a really solid report from Marriott with demand boosted by its international business, but that clearly wasn't enough to woo investors as revenue and its outlook fell short of Wall Street estimates. Shares were down as much as 4% in pre-market trading, even before that hot CPI print sent stocks down more broadly. Again, though, overall, the company did deliver on other metrics. Adjusted earnings per share came in at $3.57. That's above Wall Street's consensus estimate of $2.12. Revenue per available room increased by 7%. This is a key profitability metric for the company, and it increased 17% internationally, making up for slower growth in the U.S. And very interesting here, not only did it deliver on this metric, but Marriott's revenue per available room in 2023 actually exceeded 2019's pre-pandemic levels. So you're asking yourself here, why this reaction? Well, Jefferies analysts sum it up very well. They say a generally solid report and guide is likely not enough to push shares higher based on the strong performance in recent months, and it did have a very strong run. Marriott shares were up 67% since the end of 2022. It is the best performer in a Bloomberg index of American lodging companies. Manis.
Alex, thank you very much. The very latest on Marriott. Well, BlackRock Jean Bouvin writes this. We think the positive risk sentiment can run for a while as markets price in robust U.S. growth, cooling inflation, and Fed rate cuts. Yet, we still think elevated wage growth will push inflation back up before the end of the year. He joins me now. Good to have you with me, Jean. You look at this morning, the disruptors in the CPI at the moment are not the wages. It is the auto insurance and it is the shelter. So two of the portions of your narrative are perhaps challenged this morning. Inflation's not behaving as they possibly want, and those rate cuts are getting kicked further to the second half of the year. Good morning. Disrupted, interrupted, mildly bothered?
Well, you know, I think this is a story with nuances, and we don't like nuances. So we think inflation is going to go to 2%. Right now, I mean, if you look under the hood, we're saying, like, as you say, this is a story about shelters mainly. Core inflation, ex-shelter, is running at 2% over the last 3 months, even with this release. So I think the story is still in the near term that we're going to see inflation trending down. The market is overreacting. That has been the story for the last 18 months. We've seen that in December with the shocker FOMC, massive rally, right? And now 6 cut expected in 2024. That was overextended. I think that's getting corrected as we speak. But I think the broader story will be one where inflation is going to continue to trend down over the next few months. We're going to see cuts. But as you say, and as you quoted from your quote here, is that the bigger story is that we think once we hit 2, we're going to then be on the path that is going to rebounding later this year. So that's a nuanced story where we see the market right now reacting to a print. I think it's going to be still a market that's going to be supported by a soft landing narrative over the next few months. The Fed will ultimately cut. That's going to be the story. And then later this year, then I think this is where our worries are really more about rather than now.
I mean, I'm always drawn to those emotional bomb traders who perhaps overreact. That's the beauty about markets overreaching on the upside in terms of equity prices and perhaps overselling on the downside on the bond prices, spiking the yields. With that in mind, when you see this backup in yields, 10, 12 basis points, I know it's not massive on the short end of the curve, but likewise, 10s are moving up by 8 to 10 basis points this morning. Do you think this just presents better opportunities to buy fixed income? Because I'm reminded by Mr. Kelly, who was on surveillance just before the end of the show, that really you buy bonds for income. And of course, it is about yield to maturity. So on these backups, Jean, is it just more appealing to step in incrementally?
Yeah, so we've been, very positive on short duration bonds. I think the income story is powerful. In a world where the Fed will not be cutting rates as much as the market expected, which has been our view all along, income is a durable story. So that continues to be the case. I think a day like this makes that case. However, when you think about longer term bonds and 10-year yields, I mean, close to 10 basis points move, that's meaningful on a one data print. I think it speaks to the massive volatility that long-term bonds still, display. We're neutral. We're neutral on long-term bonds. I think we expect, on a year basis, long-term rates to be higher than they are right now.
How high? Do we retest 5%?
On a 5-year basis, I think we're going to retest 5%. That's in our capital market assumptions. But on a 1-year basis, we're going to get higher than we are now. I know, 5,
but that's because you worry.
You
You think that persistent inflation is the clearest, is one of the clearest challenges, and I suppose this then raises the question about a higher neutral rate in a higher inflationary environment. Are we moving into a different, I don't know what the right word is, paradigm, period of time, evolution of macroeconomics?
Yeah, I think, our view for the last couple of years is we've entered a new regime. We're not going back to the great moderation that was prior to the pandemic. I think there are ongoing forces that will create ongoing inflationary pressures. Doesn't mean inflation will be out of control, but it's going to require a central bank to lean against this inflation more systematically. I don't want to get into a debate about the unobserved neutral rate, but whatever that is, I think central banks will need to stay above that rate in order to contain these inflationary pressures. And so that is kind of the broader environment we're in. I think it's going to manifest itself later in this year when inflation starts to appear to rebound. And I think we're going to see a decoupling between short-term rates at that point because they're not going to go higher. They won't be lower as much as market were expecting. But we're going to see a decoupling where I think long-term rates start to move up despite short-term rates being stable. And I think there's also a big debt story that is in the back burner right now, but is relevant to this long-term rate outlook.
It's interesting. We have this little bit of a bolt disruption in CPI. As you say, take out the shelter, and we are at the 2% level. But those other disruptors have come today. This is the Bank of America Fund Managers Survey. I mean, it's hellishly bullish. Long Magnificent Seven, short Chinese equities. But they talk about the survey being the most bullish in 2 years. And cash has now been cut to 4.2%. Now, I've drawn to that because that says something to me about those money market funds and the money that was sitting on the sidelines and about deploying that. It's interesting. It's the first time that they've stopped predicting a global recession. I smell capitulation.
I think this is the story of the first part of this year. This is pretty powerful. This is the immaculate disinflation story playing out. It's going to take a while before it gets really challenged. I mean, a data like today is going to be temporarily testing it, but we're going to get other evidence that inflation is trending down. I think that's going to add to this bullish sentiment. People have been sitting on a lot of cash.
Yeah.
That's not the way to invest. At some point, you're not comfortable with this. So the temptation to deploy it in the first part of this year, I think, is pretty powerful and ultimately underpins this market.
Well, if I can be honest with you, I'm still stuck in the CD and I can't unwind it. Jean Bovin, thank you very much. Not yet. Jean Bovin there from BlackRock with his calls on the market coming up. You've had the disruptor of CPI hitting the tape this morning, coming in hotter than estimated. What will the Biden administration say about it?
We know prices are still too high because of what I call greedflation and shrinkflation. I'm calling on corporations to pass their savings on to consumers, for God's sake. We're making real progress.
Making progress, just not on auto insurance or on rents. It's a snowy day on the Dallas, Eastern Seaboard, and in the capital. Good morning from New York.
Names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. But we do a breakthrough. We look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Some companies are trying to pull a fast one by shrinking the products little by little and hoping you won't notice. Give me a break. The American public is tired of being played for suckers. I'm calling on companies to put a stop to this.
Big call from the White House there. That was President Biden using the Super Bowl as his opportunity to hit back at those companies over, you got to shrinkflation. Now, meanwhile, the CPI print coming in hotter than anybody had expected, complicating the president's message. How does he sell this? A new Financial Times poll shows Americans trust Donald Trump over Biden to handle the U.S. economy. Joining me now is Amri Hordan. Amri, normally we have the statement from the White House. We just don't have that as yet. This is going to be a hard one to sell.
Well, it is, and we saw the president this week before the Super Bowl talking about shrinkflation, trying to put this blame on corporate America. We also saw him engage in this yesterday, talking about shrinkflation and greedflation, the reason why inflation is still high. So potentially he's going to lead on that, maybe deflect. But what you see in this CPI report has a lot of political landmines for this administration. The one shining light for them is the fact that gasoline prices are so depressed. But besides that, you're seeing groceries at home, dining out, shelter. All of this is higher. And at the same time, it's not going to help the president when the fact that he's saying people are feeling better at the economy when inflation and you have these kind of prices still rising And what we see in poll after poll is that Americans still have a trust deficit with this administration when it comes to the economy, and they give his predecessor, who potentially is going to be most likely his rival in November, better scores.
Yep, it's certainly injurious in the polls at the moment. Anne-Marie Jourdain. As we get that statement from the White House, of course, we'll bring that to you. Anne-Marie, thank you very much. Sector price action for the day. Abigail Doolittle has been checking the prices since the open. Abby, what have we got?
So we're seeing something that we have not seen in quite some time. I don't think that this year, probably not since October, September, but we're looking at a pretty brutal day sector-wise. Not surprisingly, the S&P 500 down 1.4%, just the worst day in about 2 weeks. But the worst sector, real estate, down 2.9%. This, of course, is yield surge on that hot CPI print. That's the worst day since September of last year. You can also see that most of the sectors down more than 1%. So the risk-on tone is out of the markets. Those animal spirits gone right now on the idea that the Fed may not be cutting rates until July, a major repricing on the part of bond traders and liquidity. The best sector, healthcare, consumer staples, those are both defensive sectors, down about 0.6%. That actually makes this risk-off picture even more risk-off since those are down the least. As for the sell-off we're seeing for technology, well, it of course comes in the backdrop, Manus, of the big rally this year, even with today's move lower for those tech-related indexes. Take a look at the communication services index, up more than 10%, tech itself up more than 7%, and then chips up almost 7%. So this is a piece of why these stocks had been, I don't know if you would say that they were priced to perfection, but definitely ahead, investors ahead looking over their skis, and now taking some of those chips back off the table.
Yep. Abby, thank you very much. Detailed analysis there coming up on the show. We'll set the agenda for the trading diary in just a moment on Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
This is Bloomberg.
Stock euphoria interrupted as we see a spike in short-term yields. The possibility of rate cuts gets pushed out to July. We were talking about March just a few weeks ago. As you can see, the breadth of America under pressure, down 3.3%. Rising short-term rates challenges the big tech narrative, with some of the Mag 7 under pressure, and the SPUs are down by 1.34%. Let me get you up to speed with your trading diary for the rest of the week. Wednesday, it is Fed Speak again with Austin Goolsbee, and Michael Barr. Thursday, retail sales. How strong is the consumer? Plus another round of initial jobless claims. That takes us through to Friday. We've got the Fed Speak coming through from San Francisco. Fed President Mary Daly on the back of the CPI. What will the Fed speak be? We then go through the PPI at the close of the week. Right now, you're looking at Tesla off by 1.3%, Palantir down by 3.5%. So this momentum is building on the downside. Bank of America, Microsoft off by equitable amounts over 2.4%. So this is a hot CPI print, just as the Bank of America Fund Managers Survey comes in as the most bullish in a couple of years. The challenges are obvious for the Fed in terms of a respike in inflation, but they'll probably welcome the fact we're down to 4 rate cuts for 2023, down from 7 a little bit earlier in the month. That's it for Countdown to the Open. This downdraft looks as if it may persist, a bit like the snow in New York. Persistent and a little bit mizzly for the rest of the day.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. It is a snow day here in the greater New York area. We're looking out to our little snow globe outside the window, and it's kind of blowing all around. But we're here. The team is here. We'll bring you the latest. We're going to check in with Ira Jersey. He is with Bloomberg Intelligence to get his thought on its inflation data, see if that's going to impact what the Fed does. And we're going to check in with Geetha Ranganathan from Bloomberg Intelligence. Paramount, they said their CBS TV network had just record numbers of viewers for the Super Bowl. Yet they're laying off people today. So let's get the latest on what's happening there. Plus, we got the latest on all the storm stuff as well. We're going to kick this hour off with Mr. John Tucker on the Bloomberg Business Wire. John.
All right, Allison Paul, stocks diving, Treasury yields surging higher. Well, it comes after the inflation data, the so-called core consumer price index that strips out the volatile food and energy components, increasing 0.4% from December, the most in 8 months, reducing the already slim chances that the Fed officials are going to start lowering interest rates anytime soon. In fact, the latest Wall Street betting shows traders are leaning toward a rate cut in July. Blake Gwynn at RBC Capital Markets does see Fed rate cuts later rather than sooner.
We see a June 1st cut. We have 4 cuts after that, so a cumulative 5 cuts for 2024. I'll tell you, this data today, NFP on Friday, it makes me feel more confident about the June part of that equation.
Right now, the S&P 500, 71 points lower, down 1.4%, 4950 on the index. Dow Jones Industrial Average, 524 points lower. That's down 1.4%. The NASDAQ 100 right now, down 289 points. That is a decline of 1.6%. The 2-year yield, this is a whopper, 11 basis points higher right now at 458. The 10-year is 9 basis points higher. That's at 427. As for earnings, 351 of the 500 companies in the S&P 500 have reported, 78% reporting positive earnings surprises. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
All right, good stuff. John Tucker, thank you
See,
so
he
much.
doesn't have his
He
microphone
didn't have his mic on. No,
I
but he
went
was
to
ready.
you, but he was ready to go.
He was talking, so I was like, I'm gonna let him go.
Yeah, thank you. It's
You
just
know,
the blue
we're all
button thing.
professionals here.
Well,
in case you didn't know.
Hey, we all made it in here today.
We did. I didn't have any
how
problems.
was your coming in from the outer boroughs?
It was fine.
Yeah,
I came in early, just a little like snow sleeting.
Yeah.
It really wasn't too bad, but I do want to update you on that remote learning thing.
Yes.
You look at the schedule and you're like, oh yeah, this is a school day, and then like in my district, some of the links weren't working, people couldn't log on, so
So there's no such thing as a snow day anymore, right?
Not for my public school child.
I don't think there's a snow day.
But what if you're like in some poorer districts, I'll say, they don't have a computer?
So apparently you can go to your school and they're like required to give you like a laptop or an iPad or something to learn off of. But again, they only have like a limited amount. So this is not a foolproof plan.
It's not a foolproof plan. All right, let's check out what the latest is on the weather. We want to keep up on that today. Brian Sullivan, Bloomberg weather reporter, joins us here. Brian, what are we going to see here in the greater New York City area for the remainder of the day?
So you might pick up a couple more inches, and then it'll start to wind down around 1 o'clock, and it'll probably be all over and done with by 3. And by 5 o'clock, it should be relatively smooth sailing going home.
So if we go, so Paul has to go home to Jersey around 12:45. Does he get there?
Yeah, he might. I think northern Jersey is hitting the jackpot in terms of the snow. I mean, that in Pennsylvania seems to be like 6 to 8 to even up to a foot in some areas. But the city itself, it doesn't seem that bad.
So New Jersey Transit, I have full confidence in New Jersey Transit to get me home. No problem
Look at
at all.
that optimism.
Brian, what's going to happen? Is this stuff just going to be a typical New York City kind of snow? It's going to kind of melt and slushy and then kind of go away? Or what's going to happen with the temps?
Yeah, the Weather Prediction Center said the temps are going to be back up above freezing later on this week, and it'll just all disappear.
All right, that's what we'd like to hear. But again, the first snowfall in 2 years.
But it feels like we've never had snow before, the way we're talking about
Yes, it is, exactly right.
Well, I can tell you, at one of the radio stations I used to work at, a huge source of revenue in the wintertime would be companies paying us to put their notices on the air.
Oh, right.
Delayed openings, et cetera, so forth.
Yes.
And we were always told by, I won't name the person or the place, but Play up the weather. Play up the weather. So Brian would be really horrible about it because he's actually telling the truth.
Yeah, it's actually it's no big deal. All right, Brian. Great stuff. Thanks so much. We'll check in with you a little bit later. Brian Sullivan, Bloomberg's weather reporter. Big day in the markets here. The S&P 500 off at 1.5%. The NASDAQ off 1.8%. So, Alex, I mean, I guess the CPI data, we'll talk to Ira Jersey in just a moment, but a little hotter than expected. So if you're kind of saying, hey, maybe the Fed can wait, maybe you got a little bit more ammunition.
Yeah, and it was services that were higher, and also housing rents were higher, healthcare costs were higher, like the stuff that we thought was really going to roll over isn't, which just means maybe it's just lumpier. And how do you price in lumpier inflation versus directional?
All right, let's check in with Norma Linda. She covers all the equities here. She's got some underlying stories out there in this market that is selling off. Nora, what do you got for us?
Let's look at Shopify. That's ticker SHOP. This is a Canadian-based, Ottawa-based e-commerce platform, and it is seeing its biggest drop in a year. It's now pairing a little bit, but was earlier down as much as 13%. We did see revenue for the period rise 24% to $2.1 billion, beating that estimate from analysts of $2.08 billion. But Wall Street was not particularly impressed with this report after the company reported sales and profit that barely beat analysts' expectations. And this is all kind of coming after last year when the stock more than doubled in value. And so despite that happening, people are looking at this report and they're not as pleased as they want to be.
Yeah, this feels like my thing. I don't shop on Shopify, therefore it's not doing well.
Right. I mean, I've
feel like
never
that's
used.
simple.
What's the difference? What is the unique aspect of Shopify?
I have actually no idea.
I mean, I feel like
Isn't this the problem?
I've heard of people using Shopify, but I personally have not used it myself.
Okay, so I guess we're a really good audience to talk about Shopify.
Right.
Okay, let's also get to Zoom Info Technologies reported yesterday.
We had them reporting yesterday that the shares are up as much as 12%. That's the biggest gain since August of 2022. Now, there were some low expectations going into this report, so it's a little bit easier for this company to jump over that hurdle. The software company reported fourth quarter revenue that beat consensus estimates. Once again, analysts are saying that this is a solid beat overall because of that very low bar heading into that report. We had D.A. Davidson saying positive results highlight Zoom's ability to generate new opportunities, whereas Barclays says that the company is not totally out of the woods yet with respect to the headwinds that the business has had over the past several quarters.
I am a Coca-Cola person, but quite frankly, if you put a Pepsi in front of me, I'm equally as happy. I could care less. So the whole Cola wars back in the day was just a big waste of money, in my opinion. But Coca-Cola had some numbers out today. Nora, what are they saying?
Yeah, they saw a beat relative to the street expectations in regards to 2024 organic revenue outlook. It forecasts organic revenue growth of 6 to 7%. This is compared to consensus estimates of 5.9%. And still, after several quarters of price hikes to offset those rising costs that we were seeing on commodities and other inputs, Coca-Cola is saying that the increase in prices across a mix of its products was 9% in the quarter. This did come in higher than analysts were expecting, but we are still seeing those shares up as much as 1.6% this morning.
It also just feels like this is good comparatively to what they were up against, right? Like more marketing expenses, unfavorable FX rates, their cost pressures are still rising. So it kind of makes it a little extra good, especially when you then compare it with Pepsi. I wonder if it comes down to snacks.
Yeah, that's
the snack offering, right?
That's what the Pepsi people say. It's a snack company. We got a little bit of soda on the side. All right, here's the scam here. I'm calling it out. Sixth floor of Bloomberg, we have these fancy beverage dispensers, okay? And they have some soda offerings, plus water, lemonade, and all that kind of stuff. The soda is not the brand name soda. It's this organic crap. And who's ever in charge of that, and whoever is listening, bring us back some soda machines with real, like, brand name soda. I have to go down to LL2 to get my Coca-Cola.
That's quite the trek, too.
It is
also,
quite the
but
trek.
also, what does that mean? That you have LL2 winds up having, like, the bad-for-you sodas, but then the sixth floor has good-for-you sodas?
Exactly.
I feel like there's a weird message here.
John, help me out here.
For you listeners not familiar, LL2 is the basement of Bloomberg headquarters.
Thank you very much. I mean, I have talked to the powers that be on the sixth floor, and I'm getting nowhere. So maybe if somebody's listening, they can work this out. But anyway,
amazing.
Coca-Cola stock's up about 0.2%. But, you know, you look at Coca-Cola, $260 billion market cap, trailing 12 months, up 2%. So basically, I'm owning this thing for the dividend.
Yeah, exactly.
All right.
Not for huge appreciation.
Yeah, I don't get it. Anyway, Nora, thank you so much. We appreciate that. Nora Melinda, she covers all the equities for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. Again, the eco news of the day, CPI came in a little bit hotter than expected. We've got yields higher The 10-year Treasury is up about 9 basis points, 4.27%. The short end's up 12 basis points, 4.59%. Ira Jersey joins us. Thankfully, he is safe at his home office. He didn't trek that 3-minute drive to the Princeton office. So, Ira, we're glad that you're working from home and you're safe and out there shoveling. What did you make of the CPI print? And more importantly, what do you think your friends at the Federal Reserve are going to say?
Well, a couple of things. First, let me say my school district, my daughter's school district, does have a snow day today, so they are not learning online. Second, the hill in front of my house, I saw 3 cars slide down it because there's a sheet of ice under the snow. So believe me, I'm glad I didn't go into the office today just because of the treachery of getting there. Yeah, today's CPI report obviously was stronger than expected. And in particular, and I think this is something we've been harping on for a little while, it's that the services component, so that what they call supercore inflation, so services excluding housing services, grew at over 6% on a year-on-year basis, and that's that's really the component that is really driving the fact that inflation is finding it very difficult to come down as quickly as I think some people had hoped. And we've priced out basically not quite a whole nother cut, but we've priced out a large portion of another cut this year, and we're getting now toward the idea that maybe the Fed is actually only going to cut 3 times this year, which is what they've been saying. There's still a lot of people, and I was talking to some investors this morning who are thinking, well, why is the Fed going to cut at all if inflation keeps coming in like this? And I think that that's a reasonable question to be asking is the Fed ever going to cut? Now, I think that they probably will cut at least one time before mid-year, because if they don't, it'll be politically difficult for them to cut in, say, September, right during the election cycle, just because they don't want to be seen as being political, and I think that they want to get at least one out of the way. That way, they can say, well, if we cut again, it's not something that they haven't done already.
So last week I was on TV and I brought up the risk of inflation reaccelerating, and I was almost kind of laughed offset a little bit by the guest. How much do we have to worry about a reacceleration? There is no hedging against, say, another hike. Like, there is no hedging against a reacceleration necessarily. Do we need to start?
Yeah, that's an interesting point. So I think there's a couple of things. One is when you look at the composition of inflation, it's not that inflation has reaccelerated. I think some people have said that to me. It's just that it didn't come down as the market expected. It's basically flat month on month, more or less. The issue I think with the potential of another hike is that you'd really need to see a meaningful acceleration in goods prices, and goods prices continue to fall, at least very slightly. So the question is, if we do see like supply chain issues or something like that, that forces goods prices to increase another, even if it's just a little bit, like another % or something like that, that will increase all of CPI a little bit, and that would certainly keep the Fed on the sidelines. Whether or not they hike, I think you need to see a string of that kind of reacceleration, and it seemed that would be the trend in order for the Fed to hike again. But again, like, we have to first price out all the cuts that are still being priced. Keep in mind, we're still pricing for the Federal Reserve to cut interest rates 200 basis points over the next year and a half. So we have to price that out first before we start talking about the market pricing in hikes.
So when you talk to traders here, Ira, what are they doing here? I mean, it looks like today yields are up 12 basis points on the 2-year. Are people trading off of this? Are they investing off of this number, or do they trade off of this number?
Well, so investors in aggregate seem to have been more or less flat to slightly underweight duration. So that means that they're basically short interest rate risk, which means that they did pretty well today, right? With 10-year yields up about 9 basis points right now. The people had gotten long interest rates, and then they started to cut those when we got under 4%. So I think things are a little bit more balanced now. I haven't talked to a lot of traders, like high frequency traders, but the investors that I've talked to over the last couple of days certainly are, a little bit. But they're looking for an entry point to get long rates at least a little bit. They didn't like rates at 3.80. Will they like rates at 4.25? Not sure. But there certainly is some appetite for people maybe to, shorts to cover and to get flat duration, for example, and that could be coming. And there definitely is demand. You look at the auctions last week, and you guys have been really in front of the coverage on some of the auctions, on the Treasury auctions. They were really good. So there is primary demand, right? Investors still want to own Treasuries. The question is, how much do they want to own vis-a-vis the amount of supply coming outstanding, and it seems, at least today, day, everyone was surprised by this. Last thing that I have to say, most of this move, or at least half of the move in treasuries today comes from inflation break-evens. So this is the first time in the last 6 months or so that we've really seen inflation expectations move up significantly higher than they were. So that's something to keep an eye on today too.
So that explains, and obviously also the short end is getting hit too. But I gotta say, when the numbers came out, I was like, ooh, okay, let's look at this 20 basis point move, 25 basis point move we're gonna see. And it's only 12. I feel like this feels orderly to some extent. And is that because of those buyers that you're talking about, or is it a position thing?
Well, keep in mind, Alex. We've priced out 36 basis points of cuts just in the last week. So we had been selling off going into today's number. So I think part of it was people, again, position squaring, people getting flatter the market. So you didn't need to see a necessarily a 20 basis point sell-off. Real yields are probably reasonably close to fair value right here. So when I say real yields, I mean the yields on TIPS, on Treasury inflation protected securities. And I've been saying, and Paul, I know I've mentioned this to you a number of times over the past couple of months, is I think that inflation expectations, so inflation break-evens, are habitually a bit too low. And I think that those do need to kind of recalibrate to the idea that, hey, maybe we'll have 3% inflation for a long period of time instead of inflation continuing to come down toward 2% like the market's currently pricing.
Yep, very good. We've heard that from you before. We appreciate getting your thoughts here today. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, giving us some thoughts on the CPI data. And again, so yeah, I kind of thought we might see a bigger move in the short end of the curve here because this was certainly unexpected to see this kind of number come out. And so for those that are saying, hey, I think the Fed can push off here, you got some more ammunition here.
Can I just say that I feel infinitely smarter just by talking to Ira Jersey?
Oh, I always do, yeah.
Like those 8 minutes were like, I learned a lot more than I did, like the whole morning. But I do think it does come to the point of like, will this be the catalyst that you start selling off, say, just the equity market, for example? If we were sort of really overextended anyway, if positioning was super long in tech, does this provide the catalyst? And it goes for treasuries too, just how long will that sell-off then last for? Because there's still money out there wanting to buy that dip.
Yep. I think I'll just call out Bitcoin. Tom has left. We're at 48,500. We were over 50,000 earlier today.
It's a risk-off move. Does he not talk about it at all?
He does, but he might refer to it as BitDog, and I think that's a little bit disrespectful to the cryptocurrency people.
True story.
So anyway, we'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're being brought to you by Interactive Brokers. Interactive Brokers charges U.S. dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. Well, Goldilocks being chased by the three bears. The Treasury yield surging. Stocks are selling off. Traders shifting their expectations of Fed rate cuts to July. Today's Consumer Price Index report undermining Fed Chair Jerome Powell's view that the economy can keep growing and inflation can move lower all at the same time. Right now, every major industry group in the S&P 500 is lower. Real estate is the biggest drag right now. The S&P 500, 68 points lower. That's a decline of 1.3%, 49.53 on the index. The Dow Jones Industrial Average down 519 points. That's a decline of 1.3%. The NASDAQ 100 down 265 points. That is down 1.5%. The more policy-reactive two-year yield for Treasuries surging 11 basis points higher right now. The 10-year yield is up 9 basis points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right. Thank you so much, John Tucker. You're listening.
You're so welcome.
I did it. I turned on my mic first. You're listening to Bloomberg Intelligence. Alex Steele here, Paul Sweeney, where we cover all the industries and all the analysis from our fabulous Bloomberg Intelligence arm of analysts. 2,000 companies, 130 industries all around the world. And for that, we're going to focus on Paramount for a moment. That stock is down about 4.5%. The news is that they're letting go of hundreds of employees just after an amazing number of people watch the Super Bowl on all different platforms. There's only one person that you go to for this analysis, Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media. Geetha, it's twofold, right? You have the layoffs, and then you also wind up having this amazing streaming number. Walk us through your take.
Yeah, I mean, this is really more, of course, they did have a great Super Bowl, Alex, but I think this is really more about the future outlook for the company, and that is super, super bleak. Yes, it was a great night for TV advertising. We think they got in $700 million in roughly about 4 hours. But then it's more about the secular challenges. I mean, throughout 2023, we've seen TV advertising decline by low double digits. It was down almost 13% in the latest quarter that they reported. And it's not going to get too much better. And it's not just the challenges on the TV side of the equation. For them, it's also about their streaming business. And they've made good strides, absolutely, in terms of, streaming subscribers. And again, I anticipate that they're going to have some good streaming numbers to report thanks to the Super Bowl. But it is burning a lot of money. Almost $1.7 billion is what they will report in losses for 2023. And before that, they lost about $1.8 billion. So it's just been a continuous drain on the company.
So, Geetha, the stock is down over the trailing 12 months, about 40% here. And I know there's a lot of talk around perhaps the controlling shareholder, Sherry Redstone, will consider selling all or part of the company. What's the latest on that?
So the latest actually in that saga, and this has now been an ongoing drama for many months now, Paul, the latest is that Byron Allen actually came up with a bid for all of the company, not just for the controlling stake held through National Amusements. And he actually put up a pretty good bid. It was $14 billion in terms of equity, so $30 billion enterprise value. We think it was a pretty fair bid. The problem is, Byron Allen, I don't think anybody is taking him too seriously. He's, had this track record of kind of coming up with these empty bids. So while it is a number, again, we've not really seen a whole lot of action that we would have expected.
So this is a totally unfair question to Paul. Let's pretend you were still an M&A banker here, investment banker. What would you be talking to Paramount about?
I would say I think the best buyer here. There's a strategic buyer maybe Warner Brothers Discovery, but both of those companies, as Geetha well knows, balance sheets are not great. I think I would be shopping into a private equity because there's still good for free cash flows here, and let them deal with it. So, Geetha, what is the sense here as to, I think about Paramount, I think about Warner Brothers Discovery. I don't know. I mean, what happens to these companies? Because it just feels like, again, some of the big tech companies, they're just not big enough here, and against Netflix, they're just not big enough. What do they do?
So I think Warner Brothers Discovery actually had a pretty interesting move last week, Paul, which was they banded together with ESPN, Disney, and Fox to kind of create this sports super app, which will launch in the fall. And that's one way for them to kind of protect at least some part of their linear revenue stream. Because, I mean, they've kind of, everybody's seeing the writing on the wall here. We're seeing cord cutting. We're seeing about 10% of the pay TV subscriber base get eroded year after year. We've already lost 30 million subscribers. So that's one good way for them, I think, to kind of control their destiny a little bit in terms of distribution. Again, remember, Paramount is not part of that bundle. So that, again, is a little bit of, a strike against them. But you bring up a good point. I think at the end of the day, we are going to have to see consolidation. Of course, as you just pointed out, there were rumors of actually Warner Brothers Discovery being interested in Paramount, but you're right. The market did not cheer for that. That would be about more than, $60 billion, I think, in debt for those combined companies. So yeah, it is definitely going to be challenging, but I think consolidation is definitely on the cards.
Okay, so then how does that happen? Because if like 3 wrongs don't make a right, and you're not going to put all the media companies together because that's going to create more problems. So is it private equity? Like, do you split up different areas of media within the company?
Yeah, I think Paramount, one of the things has been, to sell it for parts, right? There are some parts of the company, the TV networks, that could be very, very attractive to private equity, as you just pointed out, because of the cash flows, right? It's still a business. It used to throw out about $6 billion in EBITDA, but it will still throw out about 4.5 to almost close to $4.8 billion in EBITDA. So again, highly cash generative. Of course, the future, flows don't look so great. But then there has been a lot of interest in the studio part of the business, right? Whether that's David Ellison with his Skydance Media, maybe somebody else, maybe even an Apple. We haven't necessarily seen any of those bids kind of come to fruition. But there definitely will be a lot of interest. But I think the one thing that we kind of have to wait to get some clarity on is definitely the regulatory environment. We've seen big tech kind of really shy away from anything too splashy. But who knows, maybe when the government changes, all of that will change as well.
Geetha, when these networks bid and pay billions of dollars for sports rights, and even if you put up that $700 million of ad revenue that you referenced, it's tough to make a profit on that kind of business. So what the networks have always said is, yes, but we promote other shows on our networks, and that value is really worth paying these big rights fees. But if you're promoting all these shows on the CBS network that nobody's watching because of cord cutting, how valuable is that? I mean, I thought about that. They were promoting all their shows that I don't think anybody's watching because they've already cut the cord.
Yeah, you're absolutely right. For them, though, the one thing that Paramount has done really kind of well, and I don't know whether this is a plus or a minus, but it definitely helps them at least shore up, I think, the total value of their assets, is they've actually, all of their sports properties, including the NFL, they've actually kind of leaked it outside the bundle. So they were showing it on Paramount Plus day one. And they did the same thing with the Super Bowl as well. So I think even if even if you have cord cutters, they could make the argument that, yes, people can potentially sign up for that service. We saw, of course, Peacock do that with that wild card NFL game. Again, they know that they're losing subscribers on the pay TV bundle, but so they're trying their best. I don't know how successfully, to kind of make it up on the streaming side. But you're right. I mean, it is kind of a lose-lose.
But for me, I have become addicted to Survivor. I've never seen it, and when I had a concussion, that was the show that I decided that I was going to watch. And now I'm paying like $25 a season to watch it on iTunes. And I'm like, this is getting ridiculous. That's what they got to do. They got to get people like me to then go pay for the streaming service, because I'm like, wait a minute, I spent $100 on 4 seasons of Survivor.
That could be a great promo. Yes. Survivor, preferred by more people with concussions.
Yes, exactly.
But I mean, I'm also like, wow, that's really expensive
that is.
to put out there. Geetha, so what's next? Like, what are you watching for Paramount now?
For Paramount, it is an M&A play. Something has to happen. It has to happen fast. Bob Bakish, the CEO, has pretty much said it. He said he's evaluating Byron Allen's proposal. Again, not sure whether that will necessarily pan out, but somebody has to come up with something, and it has to happen quickly.
All right, Geetha, thanks so much for joining us. As always, Geetha Ranganathan, she is the media analyst for Bloomberg Intelligence. Yeah, I don't know what you do with media in general. I mean, because I just don't, with the cord cutting and the switch to streaming, I don't know where the profits are going, and I don't know what multiple to put on whatever profits the companies tell me they're going to have.
And it's interesting when you're taking, I mean, I'll look at somebody like us, right? I mean, you started in a different world, but for me, like, I'm an on-air talent person. Like,
Yes.
this is where I have
Yes.
grown up over the last, 20 years. What do you do if there's like a next phase? Like, where is the media need going to be?
Podcasts, right?
But at some point, aren't we? You laugh because we're going to get saturated, right? Then like all the money's going to go into one thing, and the pendulum switches back. However, I have been hearing about the death of linear TV for 20 years.
Yes.
So, and it's still kicking in some form or another.
It is still kicking in, and we saw, if you want to get a big audience, partner up with the NFL and do the Super Bowl thing. 125 million viewers.
Probably
if you're an
not doing
advertiser,
that.
what's that?
I'm probably not
You're
doing
probably
that.
not.
Yeah.
Yep. But if you're an advertiser, you're like, there is no other place, full stop, where I can get that kind of reach. And $7 million at the end of the day doesn't seem like such a bad deal in a world where everybody's audience delivery has been diluted. That 125 million really stands out. S&P 500 off 1.2%, NASDAQ off 1.4%. Let's head down to Washington, D.C. right now. World and national news.
No, Michael Barr right there.
Oh, Michael
that
Barr
guy. That
with
guy.
our news in New York.
Hello,
Barr, how about
Paul, Alex, John. The National Weather Service issued a winter storm warning across the Northeast and New England. A nor'easter is poised to dump 6 to 9 inches of snow on New York City today, forcing schools to go to remote learning. In New York's Rockland County, Clarkston Supervisor George Oman says crews brine the roads.
We know that we're going to have significant issues with the rate of snow. Our advice is stay off the roads, let our guys do their jobs.
Flight cancellations and delays are also expected. Early this morning, the Senate passed an aid package to Ukraine and Israel. Senate Majority Leader Chuck Schumer hailed the vote.
It's been a long night, a long weekend, and a long few months. But a new day is here, and our efforts have been more than worth it.
The $95 billion package faces an uncertain future in the Republican-controlled House. The U.S. Supreme Court gave a special counsel until next Tuesday to respond to Donald Trump's bid to pause his criminal trial for trying to overturn the 2020 election while the former president presses an appeal that seeks immunity.